I also pay tribute also to the EU-UK negotiating team and the chief negotiator David Frost and his deputies. This process has engaged so many citizens, businesses, stakeholders, and obviously so many journalists. Thank you for your patience and for your attention. Today is a day of relief, but tinged by some sadness as we compare what came before with what lies ahead. Le Royaume-Uni a choisi de quitter.
The United Kingdom has chosen to leave the European Union and the single market, to renounce the benefits and advantages enjoyed by member states. Our agreement does not reproduce these rights and benefits, and therefore, despite this agreement, there will be real changes in a few days from now, as of 1st of January, real changes for many citizens and many businesses, and that is the result of Brexit. But we have also built a new partnership for the future around 4 pillars. Firstly, a free trade agreement, an ambitious and fair one, free and fair trade, without tariffs or quotas. And at the heart of this agreement, there will be new rules of the new economic game rules, the level playing field, as we call it, which for the European Union will be the start of a new generation of free trade agreements. Secondly, an economic and social partnership whose scope will be unprecedented. It will cover aviation, road transport, energy, combating climate change, fisheries, where we have achieved reciprocal access to waters and to resources, and with a new distribution of fishing quotas and fishing opportunities, which has been directly agreed, as is only natural, between the President of the European Commission, Ursula von der Leyen, and Prime Minister Johnson, with taking account of Britain's new status as an independent coastal state, that is a state which will no longer be part of the common fisheries policy just a few days from now. This agreement will require efforts, I know. The European Union will support its fishermen and women, will accompany them, and that is our commitment. Our partnership also includes cooperation in the field of research and innovation, nuclear safety, space, in the framework of EU programs. And in this field, our partnership will also include a non-discrimination clause concerning EU citizens, which will apply to visas, to services, and to coordinating social security. And on this point, I have just 2 regrets in terms of our societal cooperation. Firstly, the British government decided not to participate in the Erasmus exchange program. And secondly, the level of ambition in terms of mobility of citizens is not in line with our historical ties, but that again is a choice of the British government. The third pillar of our agreement concerns the security of our citizens, and we've always said that our security, that of our citizens, is not up for grabs. And combating terrorism and crime requires close cooperation between the European Union and this great country, the United Kingdom. We will continue to work together in 8 main fields, and this will entail 2 preconditions. Firstly, respecting fundamental rights and respecting personal data. And in this respect, too, in a very uncertain and unstable world in which we now find ourselves, we regret the fact that the British government has chosen not to, at least for the time being, has chosen not to reach an agreement on foreign policy, defence and development. And then finally, as regards the 4th pillar, the governance of this agreement, it is based on political dialogue and consultation.
Okay, ladies and gentlemen, I'm going to place an order to sell short euro at 121.91. Just right here. Order placed.
And effectively where necessary. As the President has said, the proposal will be put to the European Council, bringing together the 27 governments and the European Parliament. Over 4.5 years, we have worked together to build this agreement stage by stage. Firstly, the withdrawal agreement, which enabled us to stabilise peace, consolidate peace in Northern Ireland, to protect citizens' rights, to resolve financial issues, and then in full transparency, with mutual respect, and in the spirit of dialogue, we've continued working now for 9 months, which is a very short time span, to reach this partnership agreement for the future, which is unprecedented in terms of its scope and its complexity. Over these 4.5 years, the European Union has shown unity. That is its strength, unity and solidarity between all member states and with the European Parliament. It has been a great honour for me to be part of this European unity.
Merci beaucoup, Monsieur Barnier. Je vais maintenant prendre...
Thank you very much, Mr. Barnier. We can now take some questions. Could you kindly raise your hands in the system, as you know, if you wish to put a question? I see that Derek Barrett is first, so let me give the floor to Derek of Les Echos.
Bonjour, vous m'entendez?
Good afternoon, can you hear me? Yes, everything's fine. Thank you, go ahead. Yes, thank you very much. And good afternoon to you, President, and Michel Barnier. Now, what confidence do you have in the UK's capacity to respect this agreement, given their behaviour in the past?
Already built in the withdrawal agreement strong measures in case that the withdrawal agreement is not being applied properly. The infringement procedure, for example, that we started. And the same mechanisms are in this agreement, that we have strong measures that...
Well, I have to cancel the order that I placed to sell short. In the meantime, I'm placing an order to close my one position on euro. As you can see, we still have at 122.385. I think I will close, and where is it? I will point out, and I will basically reopen after Christmas something, but it's not much point to hold it over Christmas period. So 122.3, where is it? $385. Okay. And I'm going to place a stop on profit for this. Let's see where is the best. I will put at 122. Okay.
Disaster a week from now. Thank you very much.
We had a very strong negotiating position. Indeed, you're right, the time was very, very short. At the beginning of the year, we have already said very clearly that for such a comprehensive agreement, 12 months are really short, and on top came COVID. This did not make the negotiations more easy, and therefore it is outstanding what the negotiating team has done and achieved in only 12 months. That is one part, and our negotiating position was as strong because it was the European Union who said very clear, if the United Kingdom wants access to the single market, the largest single market in the world, without quota and without tariffs, then they are, as a sovereign country, free to decide whether they play by the rules like every other company in the single market too. This is the level playing field. If they do not want to follow the rules, then there will be quota tariffs, so there is a price to pay for that. And as we knew, in any case, if there would have been a hard Brexit, it would not have been good for both sides, but it would have hit the United Kingdom harder than the European Union with all its might of 450 million citizens. And therefore, from a position of strength, we were able to come forward with the most comprehensive agreement we've ever had. This agreement will write history. If you look at the clear composition of rules that are very distinct to make sure that there's fair play on both sides, that is a very clear, if you want to access the single market, you have to abide to the rules all the other ones are abiding to. And in the fishery field, I think we made a huge step forward and got a very good agreement. So this shows that from a position of strength, you can achieve a lot.
Thank you very much, President. I know that you have to go and inform the college. There is interest for additional questions, but we have a technical briefing where all the questions will be addressed. So thank you so much. Thank you so much for joining us in the European Commission's
And you have been listening to an historic news conference. Ursula von der Leyen, the President of the European Commission, announcing to the world that a trade deal has been secured, this on Christmas Eve, and it is afternoon in Britain and in Europe. A trade deal secured which formalises the United Kingdom's separation from the European Union. It is something that Ursula von der Leyen says is sweet sorrow. Those were literally the words she used, parting from the United Kingdom. Sweet sorrow, not holding back. She also dipped into 3 different languages, constantly toggling between the 3 as if to underscore the fact that a group of 27 was saying goodbye to Britain. Next is going to be the 27 countries agreeing to this. The heads of state, as we know, are already waiting for the phone calls, and presumably there will be some procedural stuff, if you like, to get through before this is all finished. We're also waiting for Boris Johnson to make a statement outside 10 Downing Street. He came back to announce to his cabinet basically what had been agreed to yesterday, and that will take place as well in the next few moments. So we want to make sure that we get to that. Boris Johnson declaring a victory today. This is Bloomberg. Now we want to get an update on where we're trading markets-wise. A few hours left in the US session before the holiday. Let's get to Greg Jarrett for a Bloomberg Business Flash.
Funny, as you might guess, stocks are edging higher in this holiday-shortened trading day as investors monitor the latest developments on the congressional aid package, while the pound is stronger after what we've been talking about, the post-Brexit trade accord agreement that has been reached. Let's take a look at the markets now. The S&P is up 0.3%, up 11. The Dow's up 0.2%, up 65, and the Nasdaq's up 0.4%, up 56. The 10-year is up 2/32 with a yield of 0.93%. West Texas Intermediate crude's down 0.1% at 48.05 a barrel. COMEX gold is up 0.2% at 18.8210 per ounce. The dollar yen is at 103.69. The euro $1.2191. The British pound $1.3562. And as I like to mention, silver is now at 25.77. That's up 0.9%. That is a Bloomberg Business Flash. I'm Greg Jarrett.
All right, Greg, thank you. And Paul, I want to bring you in here and say that it really is the end of a 48-year agreement, Britain joining what was then the European Economic Commission all the way, or the European Economic Community as it was first, all the way back in the early 1970s. And you can't overstate the importance of this day.
No, it isn't. I think you're absolutely right, Vanya, as you quoted or stated, a historic day here. And I think it's bittersweet for, I think, both parties involved. It was such a contentious issue in the United Kingdom. You know, the vote just so close there, and I think that it runs it runs so high that the feelings on both sides of the Brexit question in the UK. But it's now a done deal. There is a formalized trade agreement boy, talk about taking it down to the wire with just 7 days left. So the pressure that Boris Johnson put on both sides to negotiate a transaction and negotiate an agreement by year-end paid off in terms of getting one achieved here. So it'll be interesting to see how this plays out really over the next 12 months as some of the real nitty-gritty aspects of this transaction and this agreement are really implemented on both sides of the channel. It'll be very interesting to see how both sides adapt. Will one adapt better than the other? It'll be interesting to see.
Exactly. I mean, in a way, as Ursula von der Leyen did say, this is really the beginning of a new beginning. There's so much still to be worked out. This is really only the headline deal that has been agreed to. And there's no role for the European Court of Justice in this, not bound by EU rules, according to a UK official. We'll hear more about that, presumably, from Prime Minister Boris Johnson when he takes the podium. But as of now, it's a Brexit deal that is tariff and quota free. Ursula von der Leyen did, though, taking the time to mention that if Britain does not want to follow the rules, then there will be quotas and tariffs. So that part of things has been worked out over the last 9 months. But really, much more than 9 months. It's been 4.5 years, Paul.
It has been, and it's we've had 3 administrations in Britain during that time. Once again, highlighting the divisiveness of this issue within the UK, and it's the economic implications. Are just, I think they're hard for most people to get their heads around. We have seen some implications in terms of financial services firms moving some of their operations out of London, out of the city of London, to Dublin, to Frankfurt, to Paris. We've seen people relocate from London. So we've seen it in the financial services industry. But, the question is, what will it do to the rest of the economy in the UK and Europe? And those are the things that I think most observers, we just don't really know at this point. But it's interesting for those of us here in the States that fishing became one of the big issues at the end.
Well, and because the word sovereignty was thrown around so often in relation to British waters, and many economists making the point that, look, fisheries account for, 0.3% of GDP, and that, both sides, in particular on fisheries, very much need a deal because Britain doesn't consume much of what it catches. It imports a lot of what it eats in terms of fish. So the whole thing got extraordinarily complicated, and for more reasons than just the actual species of fish. On financial services, Paul, both sides are planning a memorandum of understanding by March. As we understand it, this is according to an internal British analysis obtained by the Guido Fawkes blog, a very nationalistic titled blog, but a memorandum of understanding by March for how this deal will impact the City of London. But as you mentioned, many businesses not waiting for this and deciding to go ahead and move at least some of their staff. We want to get to our international government reporter now for some more context and reaction. Ros Matheson joins us. Ros, we had thought that this might come on Christmas Eve. Obviously, this is a 48-year deal that has now come to an end today.
Well, that's right. You can see the big signs of relief on Boris Johnson's face that he's managed to get this through just before Christmas. Obviously, a bunch of steps still to happen to get this deal finalised. The approval of both sides. We're expecting the European Commissioners, ambassadors rather, to meet tomorrow to talk about this, and they need to ratify it as well as the UK. But certainly a feeling that this is now done and both sides can move on. You can see the language from the Europeans, and it's a fair deal that ensures cooperation and also fair competition. And it does, of course, give Boris Johnson some breathing space after a very difficult year where he's been under extreme pressure for his handling of the pandemic. He can say, well, in the end, I managed to get Brexit done. He promised to do that, and now he can try and shift the narrative forward in 2021, particularly the domestic focus on the British economy.
So, Roz, just give us a sense what it's like in London. Are folks just letting out a sigh of relief here that Brexit is so so passé given what's going on in the world? Is it just a sense of relief that it's actually over?
You could probably hear the sound.
Actually, Roz, I think we're going to break in because Prime Minister Boris Johnson is speaking outside 10 Downing Street.
Take back control of their money, their borders, their laws, and their waters, and to leave the European Union. And earlier this year, we fulfilled that promise in that we left on January the 31st with that oven-ready deal. Since that time, we've been getting on with our agenda, enacting the points-based immigration system, that you voted for and that will come into force on January the 1st, doing free trade deals with 58 countries around the world, and preparing the new relationship with the EU. And there have been plenty of people who have told us that the challenges of the COVID pandemic have made this work impossible, and that we should extend the transition period and incur yet more delay. And I've rejected that approach precisely because beating COVID is our #1 national priority. And I wanted to end any extra uncertainty and to give this country the best possible chance of bouncing back strongly next year. And so I'm very pleased to tell you this afternoon that we have completed the biggest trade deal yet, worth £660 billion a year, a comprehensive Canada-style free trade deal between the UK and the EU, a deal that will protect jobs across this country, a deal that will allow goods, UK goods and components to be sold without tariffs and without quotas in the EU market, a deal which will, if anything, allow our companies and our exporters to do even more business with our European friends, and yet which achieves something that the people of this country instinctively knew was doable, but which they were told was impossible. We've taken back control of our laws and our destiny. We've taken back control of every jot and tittle of our regulation in a way that is complete and unfettered. From January the 1st, we are outside the customs union and outside the single market. British laws will be made solely by the British Parliament, interpreted by UK judges sitting in UK courts, and the jurisdiction of the European Court of Justice will come to an end. We will be able to set our own standards, to innovate in the way that we want, to originate new frameworks for the sectors in which this country leads the world, from biosciences to financial services, artificial intelligence, and beyond. We'll be able to decide how and where we're going to stimulate new jobs and new hope with free ports, new green industrial zones. We'll be able to cherish our landscape and our environment in the way we choose, backing our farmers, backing British food and agricultural production. And for the first time since 1973, we will be an independent coastal state with full control of our waters, with the UK's share of fish in our waters rising substantially from roughly half today to closer to 2/3 in 5.5 years' time, after which there is no theoretical limit beyond those placed by science or conservation on the quantity of our own fish that we can fish in our waters. And to get ready for that moment, those fishing communities will be helped with a big £100 million programme to modernise their fleets and the fish processing industry. And I want to stress that although, of course, the arguments with our European friends and partners were sometimes fierce, this is, I believe, a good deal for the whole of Europe and for our friends and partners as well. Because it will not be a bad thing, in my view, for the EU to have a prosperous and dynamic and contented UK on your doorstep. And it will be a good thing. It will drive jobs and prosperity across the whole continent. And I don't think it'd be a bad thing if we in the UK do things differently or take a different approach to legislation. Because in so many ways, our basic goals are the same. And in the context of this giant free trade zone that we're jointly creating, the stimulus of regulatory competition will, I think, benefit us both. And if one side believes it's somehow being unfairly undercut by the other, then subject to independent third-party arbitration and provided the measures are proportionate, we can, either of us, decide as sovereign equals to protect our consumers or businesses. But this treaty explicitly envisages that such action should only happen infrequently. And the concepts of uniformity and harmonisation are banished in favour of mutual respect and mutual recognition and free trade. And for squaring that circle, for finding the philosopher's stone that's enabled us to do this, I want to thank President von der Leyen, Ursula von der Leyen of the European Commission, our brilliant negotiators led by Lord Frost and Michel Barnier on the EU side, as Stephanie Risso, as well as Oliver Lewis, Tim Barrow, Lindsay Appleby, many others. Their work will be available for scrutiny, followed by a parliamentary vote, I hope, on December the 30th. This agreement, this deal, above all, means certainty. It means certainty for the aviation industry and the hauliers who have suffered so much in the COVID pandemic. It means certainty for the police, the border forces, the security services, all those we rely on across Europe to keep us all safe. It means certainty for our scientists who will be able to work together and continue to work together on great collective projects, because although we want in the UK to be a science superpower, we also want to be a collaborative science superpower. And above all, it means certainty for business, from financial services to our world-leading manufacturers, our car industry, certainty for all those who are working in high-skilled jobs and in firms and factories across the whole country. Because there will be no palisade of tariffs on January the 1st, and there will be no non-tariff barriers to trade. Instead, there will be a giant free trade zone of which we will at once be a member, and at the same time be able to do our own free trade deals as one UK, whole and entire England, Northern Ireland, Scotland, Wales together. And I should stress, this deal was done by a huge negotiating team from every part of the UK, and it will benefit every part of our United Kingdom, helping to unite and level up across the country. And so I say again, directly to our EU friends and partners, I think this deal means a new stability and a new certainty in what has sometimes been a fractious and difficult relationship. We will be your friend, your ally, your supporter, and indeed, never let it be forgotten, your number one market. Because although we have left the EU, this country will remain culturally, emotionally, historically, strategically, geologically attached to Europe. Not least, of course, through the 4 million EU nationals who have requested to settle in the UK over the last 4 years and who make an enormous contribution to our country and to our lives. And I say to all of you at home at the end of this toughest of years that our focus in the weeks ahead is, of course, on defeating the pandemic and on beating coronavirus and rebuilding our economy and delivering jobs across the country. And I'm utterly confident that we can and will do it. By today, we've vaccinated almost 800,000 people. And we've also today resolved a question that has bedeviled our politics for decades. And it is up to us all together as a newly and truly independent nation to realise the immensity of this moment and to make the most of it. Happy Christmas to you all. That's the good news from Brussels. Now for the sprites. Actually, it's now for the media. Let's go to the media, who I think we've got Laura Kuenssberg. Over to you, Laura.
Thank you very much, Prime Minister. We're yet to see the text of this deal, which we understand runs to some 2,000 pages. You've presumably had the benefit of poring over every word, or maybe perhaps not every single word. But can you tell the public honestly, where did the UK give the most ground? And where did the EU compromise the most, do you think?
Thanks, Laura. Well, actually, it's only about 500 pages, and I think it would, and it's readily intelligible. I think it would be fair to say that we wanted to make sure, for instance, that we got access to, got complete control of our fisheries from the get-go, and that's just to say we had annual negotiations on fisheries within the shortest possible delay. The EU began with, I think, wanting a transition period of 14 years. We wanted 3 years. We've ended up at 5 years. I think that was a reasonable transition period, and I can assure great fish fanatics in this country, we will, as a result of this deal, be able to catch and eat quite prodigious quantities of extra fish. So that's why we're going to have to make these investments in the fishing sector. Thanks very much, Laura. Let's go to Robert Pest of ITV. Sorry, Robert, you need to unmute. You need to unmute, Robert.
Prime Minister, you said all along you wanted a Canada-style deal, but what you've agreed means that we in the UK have to follow EU rules on subsidies, on tax, on workers' rights, on the environment, or potentially incur the imposition of tariffs. That's right, isn't it? I mean, we've just heard Ursula von der Leyen say that she got her level playing field, which you've explicitly rejected all the way through. You also just said there would be no non-tariff barriers. Again, that's not right. From January the 1st, as a result of leaving the customs union, and Michael Gove has been warning about this week in, week out for months, there is a ton of new bureaucracy on British businesses, lots of new non-tariff barriers. This is not to say the deal is a bad deal, but you're not selling it correctly, are you? You're mis-selling it.
No. Rob, I must respectfully disagree with you, because there is indeed a clause in the deal which is nothing like as damaging as it was, and is, in my view, neutralised, which says that if either country feel that the other one is in some way undercutting them or dumping in some way, then subject to arbitration, and provided the measure is proportionate, and that, I mean, independent arbitration, not arbitration by the European Court of Justice, but subject to an independent panel, they can, if they really choose, put on tariffs to protect their consumers and their businesses. And to give you an example of the kind of thing where that might occur, for instance, in the UK, we want to go further on animal welfare standards, and it might be that we do things, for instance, on how you rear pigs, banning sire crates and so on, that would incur extra costs for our pig farmers, and it might be that bacon coming from elsewhere from the EU was at risk of, therefore, of undercutting. We might, under those circumstances, consider imposing tariffs. I think it's highly unlikely, but we might consider it. It would have to be subject to arbitration. It would have to be proportionate according to the arbitrator, and under no circumstances would we be in any way constrained, legally or otherwise, by anything that the EU did or chose to do themselves, nor, furthermore, would there be any role for the European Court of Justice. And for people at home who zoned out while I've been talking about this, let me tell you, this is a very, very long day's march from where we were a few years ago. You will remember, Robert, when we were talking about basically having a common rule book with the EU and having dynamic alignment with EU law, so that the UK was forced to keep step, and that has gone from this treaty insofar as the EU wanted it, and there is no role for the European Court of Justice whatever. So I think it's a great treaty, and as for your point about non-tariff barriers, yes, I think it's important to stress what I'm talking about is barriers on the grounds of your plugs won't work in our country, therefore they're banned or whatever. That kind of technical barriers to trade, and there's a lot in this treaty to try to reduce all that kind of thing, make sure that doesn't happen. That's a good thing. That's a good thing for businesses and consumers. And in that sense, it's a great free trade deal. But I must stress to people getting ready for January the 1st that there will be change. So people will need get on the gov.uk website, exporters will need their AORI forms and everything else. People should be aware of the change that is coming. But there's also an opportunity, because for British exporters now, the whole world will be treated the same for export purposes. And I think that will actually galvanise our exporters to think much more positively and dynamically about the opportunities that they have. So I must respectfully disagree with both the points that you made. This is a jumbo Canada-style free trade deal of exactly the kind that I think this country needs. And as I say, I believe it resolves a long-standing and very, very difficult problem. People said you couldn't be part of a free trade zone with the EU without being obliged to follow EU laws. If you remember, people. I think we were told we couldn't have our cake and eat it, and that kind of thing. I'm not going to claim that this is a cakeist treaty, Robert. But it's because that. But it is. I believe what the country needs at this time, and the right way forward for the UK. Let's go to Sam Coates of Sky.
Prime Minister, you say this is an unprecedented deal that observes all your red lines and promises to the country. Can people trust that life will be better as a result of this deal and that there won't be any disruption even in the short term? And can you guarantee the government won't end up reopening elements of the new relationship in the years to come?
Well, Sam, I mean, really good questions. I mean, short term, yes, as I said just now, there are things we have to get right, the processes that maybe people have to do that they need to be aware of, and I'm going to assume that point really is worth reinforcing. I do believe that the freedoms that this treaty wins us, basically a new independence from the EU, are worth having. But and so free ports, free trade deals, being able to do, as I say, to look after your livestock differently, improving your landscape in a different way, doing all sorts of things differently, regulating financial services differently, chemicals, all sorts of things where we may want to do things differently and better. But I'm just saying to people watching this, and I'm sorry for disturbing Cars 3, by the way, to people watching this, I would say it's one thing to get freedom. Winning freedom is a fantastic thing, and that this is an important element of what we've done. But it's how we use it, how we make the most of it. That's what's going to matter in the months and years to come. And I've no doubt that we can do fantastic things with this treaty if we with this new relationship, which I think will be stable and prosperous for both sides. Let's go to Tom Newton-Dunn of Times Radio.
We are listening to British Prime Minister Boris Johnson explain to the British public on Christmas Eve out of London and 10 Downing Street how they have arrived at a deal to leave the European Union, having been in the European Union and previous iterations since 1973. Fisheries had been the latest sticking block. That has been resolved. He says that we will be an independent coastal state with full control of its waters, and the UK's share of fish in the waters will rise substantially. And he actually said we will be able to catch and eat quite prodigious quantities of extra fish. So that's the fish question. About a 500-page deal. We'll get more details on that when it's released. But for now, Boris Johnson taking questions from the British, mostly, press. And earlier we heard from EC President Ursula von der Leyen, which said, parting is such sweet sorrow. Let's get back to British Prime Minister Boris Johnson and the questions.
I mentioned, I think, to Laura, where we got to on fish. We started out wanting a very short transition period of 3 years. They wanted a much longer one of 14 years. We've compromised on that at 5.5. And on the vital services sector, yes, of course, they feature in this deal quite rightly. There's some good language about equivalence for financial services. perhaps not as much as we would have liked, but it is nonetheless, going to enable our dynamic City of London to get on and prosper as never before. There's some good stuff about barristers, solicitors, lawyers being able to practice around the European Union. We will be able to continue to have massive and growing economic interpenetration without the need for what I've always talked about, this lunar pull of EU law. And as I say, this is something that I think can benefit people on both sides of the channel. Be a healthy, dynamic, productive, happy, stable relationship. That's what we're aiming for. Let's go to George Parker of the FT.
Thank you, Prime Minister. You mentioned the change that will happen at the border in any event on January the 1st. I just wondered if there was anything in this deal where the two sides have agreed to introduce some sort of flexibility at the border to make sure we don't have chaos in Dover and Calais on January the 1st. And a second, more general point. You and I used to be reporters in Brussels, and we've covered the sort of psychodrama of British-EU relations for a number of decades. Nigel Farage said today that the war is over. I just wondered if you saw it in those terms.
No, I think first of all on the border and measures to there are all sorts of things in the treaty that what you will recognise about trusted trader schemes and special measures on sanitary and phytosanitary recognition and steps to make sure that things flow as smoothly as we possibly can. Though again, I stress that there will be things that people have to do. Look, I mean, the EU was and is an extraordinary concept, and it was born out of the agony of the Second World War, founded by idealistic people in France and Germany and Italy who never wanted those countries to go to war with each other again, and other countries, Belgium, Holland, and others. And in many ways, it was and is a very noble enterprise. So I don't recognise the kind of language that you talk of. I think that the UK's own relationship with it was always difficult. We always found some of the language about ever closer union, the idea of this political union, this very dense idea of this ideology of endless integration. We found quite hard, George, and I think you as a fellow Brussels reporter, you'll remember that there was quite a lot of friction involved. I think that what we've got here is the basis of a new long-term friendship and partnership that basically stabilises that relationship. And insofar as the UK needs to be, and always must be, a great European power, always must be a great European power, where they're outside the main body of the EU, but we're there as a friend and as a supporter, as a flying buttress, if you like, to make sure, as we have done so many times in the last couple of hundred years, that we're able to lend our voice when it's needed and to be of value to our European friends and partners in a strategic way. And that's what the UK will obviously continue to do. But I think the very dense programme of integration wasn't right for the UK, and that's why it was right to take back control in the way that we have. And I think that this deal expresses what the people of the country voted for in 2016, and I think there was a wisdom in what they decided, and I think that we'll be able to go forward on this basis. Let's go to Gordon Rayner of The Telegraph.
Thank you, Prime Minister, and Merry Christmas for tomorrow. Could I just ask, probably half the people watching this right now would have voted Remain in the referendum in 2016. Do you have a particular message for them? People today are tweeting that this is a bad deal, that it's not what they wanted, they would rather have stayed in. What's your message to them? And just secondly, can I also ask you, we've had more figures today on COVID, you mentioned COVID earlier. Can you rule out another national lockdown after Christmas?
Well, Gordon, thanks. I think my message to everybody on both sides of the divide of that argument in 2016 is I really think it's now a long time behind us, and I think most people that I talk to, whichever way they were inclined to vote back then, just want it settled and want us to move on. And I think this gives us the platform, the foundation for a really prosperous new relationship. And I would be very excited now by this deal. You know, this European question has been going on for decades. Exactly what relationship we should have. This is a great new free trade deal, with a trading relationship and partnership that I think will bring prosperity to both sides of the channel. And on coronavirus and the struggle there, obviously we face very considerable new pressures, particularly from the new variant and the speed with which that's been spreading. We believe that we're going to have to get through this tough period now with, as I've said many times, very tough restrictions, with tough tiering, and you'll have seen what's been announced over the last day or so about that. And much as I regret that, I do think it is necessary for us to grip this virus now, to stop it running out of control in January, because we need to buy ourselves time to get the vaccine into as many arms of the elderly and vulnerable as we can. And that is the real way in which we will defeat the virus. So it's tough tiering, community testing, and rolling out the vaccine. And we're going to continue with that approach. And I know that it's been very, very tough over the last few weeks, and I must tell people it will continue to be difficult, not least but basically because of the speed with which the new variant is spreading. But the vaccine is going into people's arms, and there really is now, I think, hope, the certainty that we will have it defeated, as I say, by the spring. Well, that's certainly what the scientists still believe, and they're still confident of that. So thanks very much, Gordon. Let's go to Harry Cole of The Sun.
Thank you, Prime Minister. Can you give us some more details about the new security arrangements with the EU? Are we going to be as safe next week under your new security partnership as we are today, given that Brussels is saying that they're going to lock us out of live EU databases? And given you've locked us all up, how will you recommend we celebrate leaving the EU next week?
Well, Harry, look, I leave your manner of celebration entirely to you and to individual taste. I wouldn't want. I mean, I think the government done quite enough bossing people around, recommending this or that over the last 10 months or so. But on security and police cooperation, I'm absolutely confident this is a deal that protects our police cooperation and protects our ability to catch criminals and to share intelligence across the European continent in the way that we have done for many years. So I don't think people should have fears on that score, or indeed on any score. Let's go to Heather Stewart of The Guardian.
Hello, Prime Minister. Michel Barnier said today that we decided to leave the Erasmus exchange scheme, which sent thousands of students to EU countries every year. I wonder what you'd say to young people who feel as though opportunities to discover the continent on our doorstep by living there or studying there or working there are being taken away from them. And secondly, do you have a message for Keir Starmer, who will have to decide in the coming hours and days how to whip Labour MPs, whether they should support your deal?
Right, Heather. Well, look, on Erasmus, it was a tough decision. The issue really was that, as you know, the UK is a massive net contributor to the continent's higher education economy, because over the last decades we've had so many EU nationals, which it's been a wonderful thing. But our arrangement's basically been that financially the UK exchequer more or less loses out on the deal. Erasmus was also extremely expensive. So what we're doing is producing a UK scheme for students to go around the world, and it'll be called the Turing scheme, and it will so students will have the opportunity to named after Alan Turing. So the students will have the opportunity not just to go to European universities, but to go to the best universities in the world, because we want our young people to experience the immense intellectual stimulation of Europe, but also of the whole world. And as for, I think you asked about which way should the opposition vote on this. Well, it's perfectly obvious. The opposition should vote for this excellent deal, and I would strongly encourage everybody to do the same. Thank you very much, everybody. Happy Christmas to you all. Thank you.
You've been listening to British Prime Minister Boris Johnson explain some details about how life will move forward in a newly independent and perhaps more sovereign United Kingdom. This having joined the European Economic Community all the way back in 1973. Today is the day that it has secured a deal for trade and other items post-leaving after that Brexit vote that happened back in 2016. An historic and momentous day, really, Paul.
It really is for both sides, Vonnie, the European Union and the UK. And I think as we were just listening to Prime Minister Boris Johnson, clearly a victory for him and for his party and for the, quote unquote mandate he was given to get Brexit done. And I think as we heard from his comments, he has clearly achieved that. And now, arguably, the hard work begins for both sides to try to implement, the framework, a trade framework, and other types of frameworks for the relationship going forward. There's obviously lots of devil will be in the detail over the next coming months and years.
Yes, quite a sober news conference, and I would say that. He didn't want to stomp on anything. He didn't want to, tell anybody how to celebrate, should there be celebrations and so on. He made that very clear, but he did continue to underline the fact that it had been a fractious relationship and this deal means now a new stability. He talked about being Europe's ally, Europe's supporter, and Europe's #1 market. Then he was accused a little bit of mis-selling the deal by one reporter who suggested that perhaps there are, in fact, things like tariffs and so on in the deal, and he pointed out that a clause within the deal does say that if either party feels they're being undercut by the other, they can, subject to arbitration, impose tariffs to protect their consumers and businesses. That arbitration is going to be a matter of a lot of discussion over the next few months, because apparently the European Court of Justice has absolutely no jurisdiction here, and for the UK at least, everything related to the UK will be decided by UK courts, and the jurisdiction of the European Court of Justice, as Boris Johnson put it, will have come to an end.
Yeah, it's very interesting. I think for those who voted to leave, that sense of sovereignty was clearly a big issue, and presumably that has been achieved here. Right now, Vonnie, let's bring in Roz Matheson. We'll bring her back in. She's from Bloomberg News, covers international government for Bloomberg News, and she is based in London. Roz, thanks so much for joining us again. What did you take away from Boris Johnson's comments this morning?
Well, you saw a lot of the rhetoric that he's been using for quite some time, which is the idea that this will enable Britain to be a sovereign nation again, to be independent, to take back control. And that's what he's really sold Brexit on, that the UK can now stride out on the world stage on its own, essentially, and make its own decisions. But within that, he's also said that the UK is going to enjoy the benefits, essentially, of being in a free trade zone with Europe, but able, again, within that, to set their own rules. One thing he was a little less willing to talk about is the reality of what's going to happen now, because even though the UK is no longer part of the customs union, the single market, trade won't just be automatic as a result. There are potential non-tariff barriers to companies operating. They'll need to file new paperwork. There's the possibility stuff will still be held up in the border, and particularly for finance companies, there's uncertainty about how they can operate inside the Eurozone if they're British financial companies, and also just for ordinary people living on either side of the channel, how they now go back and forth. There's a lot that's still yet to be unpicked in all of this, and some of that we'll only know once we actually begin. But you can see the jubilation. Boris Johnson wearing a fish tie, perhaps a nod to the last-minute difficulties in the talks today, but certainly feeling like he's now delivered for the British people and very much trying to push the narrative forward. Now we're looking forward into next year. We've got this done. We can move on to other things.
Absolutely. Well, he delivered what he had been put in there to deliver, I guess, is his thinking, and he delivered it. Something that Theresa May and previous prime ministers couldn't deliver. The question is what his role will be going forward now and what kind of a mandate he has, what will be the next sort of list of priorities on the part of the Conservatives. Both sides plan a memorandum of understanding on financial services by March, Roz. Does that mean that March is a sort of a month where we'll see a lot of nitty-gritty wrapped up?
Well, that's right. There's a lot of nitty-gritty in many parts of this, including for the financial sector. And you can see that the European Parliament's going to defer sort of a vote on this essentially to the end of February and just say, well, for now, we'll just say it's ratified, but we'll come back to it then. And you can see already, you can see the comments that are coming from Germany. They're going to look at this in quite a lot of detail. So there's still some hurdles to get over, and there's a lot of specifics to be worked out. So they've got a framework agreement, but they also are having transition periods for a lot of it, including on fishing. So things will eventually taper off and new agreements will need to be reached. So there's a lot still to be unpicked on either side. The general feeling is that this deal should go through the ratification process on both sides, but we are seeing the hard Brexiteers already saying they're going to put the spotlight on it and look at it very carefully.
Hey, Roz, thanks so much for joining us. We know it's a busy Christmas Eve for all involved. Roz Matheson, she's international government reporter for Bloomberg News, joining us from London. Right now, we want to bring in Therese Raphael, Bloomberg European Economics and Politics editor. Therese, thanks so much for joining us. It seems like we've been talking to you almost on a daily basis there for some period of time on Brexit. What are your thoughts here, having listened to the comments from Ursula von der Leyen and Boris Johnson this morning on this trade deal?
Yeah, what was striking was just the very different tones that we heard from both the EU and the UK Prime Minister. So from von der Leyen and Michel Barnier, it was quite sober. Both of them talked about a sense of relief, but also regret. And both of them talked about the EU moving forward, progressing, advancing. We heard those kinds of words. And, finally, both of them emphasized that this was not a free lunch for the UK, that the access that was being done, that was being agreed, is beneficial to the UK, but it also comes with strings attached. And those strings are going to prevent British businesses from undercutting EU businesses, so that the competition factor, the level playing field that we've heard so much about throughout most of this year, has been maintained. So, the EU was quite subdued. Boris Johnson, of course, has come out, with a tone that can only be described as triumphant. And we can understand why. He's delivered on his campaign promises, but he's been less willing to talk about, as Rosalind said just before I came on, the costs of Brexit. In fact, he said that there would be no non-tariff barriers to trade, which is just patently not the case. There will be significant non-tariff barriers to trade, and British businesses are going to find that out in a matter of days. But for now, it's a political victory for him.
And he was in fact accused of mis-selling the deal at one point today, but he wanted to downplay anything that went beyond sort of the broad outline of the deal. I'm sure that the British public and even his own cabinet and parliamentarians will be digesting it over several days. It's 500 pages after all. He did mention, Therese, that there will be an arbitration process in cases where either party feels they're being undercut by the other. Where does that arbitration process now take place? Because we know the European Court of Justice won't have any part in it, and surely the United Kingdom won't be able to unilaterally decide anything in its courts.
Well, until we have the text of the deal, we won't be able to say for sure. It looks like there will be an independent panel, probably composed of experts agreed to by both sides. That's not, entirely unusual. We even have in the Northern Ireland Protocol, a committee composed of members from a joint committee from both the EU and the UK that make decisions. So, I think the most important thing from Johnson's perspective was to make sure that the ECJ had no say in this, that it is not in this treaty at all. That would have been a real red line line for his backbench, hardline Brexiters in the European Research Group. So, he's found a way around that, and we'll have to wait for the actual text to understand exactly where the triggers are and what happens if the two sides disagree.
Therese, any sense of over coming months and really coming years, what is the point of view of the EU in terms of how aggressive do they expect to be? Like, are there hard feelings on the part of the EU such that we will see that reflected in the coming months and years with various decisions and how they deal with the UK? Do they still feel like they've been spurned and as a result they're going to be very cautious as it relates to being accommodative to the UK?
Yeah, I don't think the EU does that kind of, sort of emotive decision making. I think they're highly pragmatic, and they will be content to some degree that the torturous process to get to this point would serve as some sort of deterrent on, other EU countries entertaining the notion of leaving. That said, they understand that Brexit weakens the EU. Britain leaving the bloc makes it smaller economically and in terms of political weight. So they will be very keen to, ensure that the remaining 27 can reinforce the value proposition of the EU. So we've seen that with the aid during the pandemic, and I think we'll see a greater sensitivity toward ensuring that that the EU proves that it has come through this process stronger. And at the same time, we're going to see that from Boris Johnson. Everything he does from now on is going to have to be labeled as a dividend of Brexit, something that freedom gives the UK, enabled him to do. So on both sides, we're going to see a lot of justifying of the costs and the enormous energies that have gone into this.
Just a quick little anecdote for you both from the news conference. The Erasmus program, which was hugely popular among students and named after the Dutch philosopher from the Renaissance period, is now going to become, in England at least, the Turing scheme after Alan Turing, of course, and it will be around the world and not just Europe that students will be able to engage in a year swapping places, but we'll see how that works out as well.
Therese Raphael, thank you so much for joining us. We know you're certainly super busy on this Christmas Eve. We appreciate your thoughts and commentary as we've been talking over the years about Brexit. Now we have a final trade deal. Therese Raphael joining us. Right now, let's head down to Washington, D.C., our 99.1 studios for world and national headlines.
All right, Paul, thank you. I'm Nathan Hager in the Bloomberg 99.1 Washington newsroom. The UK, of course, has clinched a historic trade deal with the European Union just a week before Britain is set to leave the bloc. Prime Minister Boris Johnson says it's the biggest trade deal his country's ever made.
A deal that will protect jobs across this country. A deal that will allow goods, UK goods and components to be sold without tariffs and without quotas in the EU market. A deal which will, if anything, allow our companies and our exporters to do even more business with our European friends.
European Commission President Ursula von der Leyen calls it a fair and balanced deal, though she says Britain's departure is bittersweet. Johnson says Parliament will vote on the agreement Wednesday, the day before Brexit. The House here in Washington is set to vote Monday on $2,000 coronavirus stimulus checks for most Americans after Republicans blocked an effort to do it by unanimous consent. Bloomberg's Irv Chapman has an update.
Before anything else, House Democratic leader Steny Hoyer urged the president to sign the compromise bill that passed both House and Senate.
And I urge him and hope that he will sign the bill. Surely, the president of the United States, whether he's in Mar-a-Lago or any place else, ought to empathize with the pain and suffering and apprehension and deep angst that the American people are feeling this Christmas Eve.
The House plans to vote on the bill to raise the payments to $2,000 on Monday afternoon, with no indication that the Republican leader of the Senate will then bring it up. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg. Quick Take powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Stocks edge higher in holiday shortened trading as investors monitor the latest developments on the congressional aid package, while the pound is stronger after a post-Brexit trade accord agreement has been reached. Let's take a look at the markets as we do every 15 minutes throughout the trading day. The S&P 500 is up 0.2%, up 7. The Dow is up a little over 0.1%, up 47. And the NASDAQ is up 0.1%, up 20. The 10-year is up 3/30 seconds with a yield of 0.93%. West Texas Intermediate crude oil is currently down 0.5% at 47.87 a barrel. COMEX gold's up 0.2% at 18.8180 an ounce. Dollar yen 103.64. The euro $1.2186, and the British pound $1.3539. Bitcoin just won't go away. The original cryptocurrency again had commentators eating their words in 2020. It's now time to accept it's here to stay. Like Monty Python's Black Knight.
You've got no arms left. Yes, I have. Look, just a flesh wound.
Bitcoin believers believe that a near fatal volatility is a mere flesh wound. Drops of 80% are welcomed as fortuitous buying opportunities, but far from being a weakness. It appears it is evidence of the asset class's longevity. Right now, Bitcoin is down 0.2% at $23,258 per. That is a Bloomberg Business Flash. I'm Greg Jarrett.
This is Bloomberg Markets with Paul Sweeney and Bonnie Quinn on Bloomberg Radio.
All right, well, it is anemic markets this Christmas Eve in the United States and this Brexit Day in London and across Europe. Let's talk a little bit about the year-end markets now, though, and also what might happen today and tomorrow, given that President Trump has actually vetoed that bill and the GOP doesn't seem to be interested in the $2,000 checks that President Trump has been speaking about. Bloomberg Markets brought to you by Commonwealth Financial Network. For the 6th straight time, J.D. Power ranks Commonwealth #1 in independent advisor satisfaction among financial investment firms. Visit commonwealth.com to learn more. So to do all that, let's bring in Michael Clark, Managing Director at River and Mercantile Solutions. Michael, summarize where you think we are this last session before at least the Christmas holiday.
Yeah, Bonnie and Paul, happy holidays to all of you. Obviously, what we're seeing in the markets today, I think, caution as we go into the last week of the year. And a lot of that, I think, will depend on how things play out the rest of the year with rates and markets. I'm guessing things are going to be fairly calm, even though there's a lot at stake.
So, Michael, for your pension fund clients, how do they adjust if they do their actuarial outlook? I mean, I'm looking at the 10-year, 93 basis points, the 2-year, 11 basis points, just under 12. How do they think about the next 3 to 5 years? It's not going to be like the last 3 to 5 years, is it?
No, you're exactly right, Paul. And that's something that when we look at where we were at earlier this year, we were kind of in the worst case scenario for pension plan sponsors, low rates, falling markets. Obviously, we're in a different spot today with markets having come up substantially throughout the rest of the year. But where we go from here, there's a lot for pension plan sponsors to consider. As it relates to corporate pension plans, those low rates will continue to push liabilities up. And what's more maybe impactful on the corporate side is the fact that this last round of coronavirus stimulus talks did not include any pension funding relief. Those pension plans have benefited from funding relief that's been in place basically for the last 7 or 8 years, and it's set to start expiring this year in 2021, this coming year. That will mean bigger contributions down the road for those pension plan sponsors. For public pension plans, the big thing here is that with these lower rates, similar to what we've seen over the last 10 to 15 years, there's been pressure on those plans to reduce their expected long-term rate of return expectations. Those are directly tied to the discount rate that they use to value the liabilities. It will be interesting to see as we look at capital market outlook assumptions, if those still face downward pressures, there could be additional pressure for these entities to lower those expected returns even more. Lower discount rates mean higher liabilities, higher contributions to fund those deficits. And really, I think the big question is what happens if the tax base supporting these plans is struggling as well?
Yeah, exactly. I'm curious as to what you think a change in administration might mean in terms of even legislation that will impact the pension fund business.
Yeah, there's a lot that's on the table there. In the summer, when the House had passed the HEROES Act, there was actually additional funding relief for corporate pension plan sponsors, but those provisions did not make it into the bill that passed Congress earlier this week. I do expect that we'll see more rules around fiduciary standards and things of that nature, even things on the 401k side. It will be interesting to see how the new administration tackles the problems that are facing the pension plan side of retirement, especially not just the corporate side, but multi-employer plans as well, where they're backstopped through the Pension Benefit Guaranty Corporation is in a far worse state than it is for your traditional single employer plans.
So, Michael, given this low rate environment we've been experiencing, and Fed Chairman Jay Powell suggesting that it's going to be lower for longer, are you finding pension plans, what are they doing most commonly to try to get yield? Are they taking perhaps too much risk by going into riskier asset classes like emerging markets or private equity and things like that? What are you seeing?
That is the worry, right? When you look at the overall just pension risk management perspective, on the public pension plan side of things, that's absolutely what we're seeing more of, more into equities, more into alternatives, to try to combat the fact that we're now in this low yield environment and are anticipated to be there at least for the near term. It really requires those trustees that manage those plans to take a step back, look at holistically what strategies and tools are available to help them protect against the downside, because taking on more risk, if we end up in a market correction again, is only going to set them back further, but still offer upside potential, right? And so that requires using all the tools in the pension risk management toolbox. We have to start looking outside of the traditional and start looking at other strategies that might be available to help those plan sponsors accomplish their goals.
Michael Clark, thank you so much for joining us. We appreciate that. Michael Clark, Managing Director and Consulting Actuary for River and Mercantile Solutions, based in Denver, Colorado. Vonnie, it's interesting when you think about some of these pensions funds and the managers, when they have to generate returns for their pensioners in this type of environment, with these chronically low rates, the returns, again, the next 3 to 5 years, unlikely to match what we've seen over the last 3, 5, 10 years.
And let's face it, since the financial crisis, it's not like those return assumptions were, as high as they would have been once upon a time as well, Paul. So it's been quite the difficult year for pension funds as well.
Yep, exactly. A quiet day in the markets here. We do have some green on the screen, but we're just up about 0.1 to 0.2%. Looking at the indices here on what we know will be a quiet Christmas Eve. We'll have more coming up. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Markets.
Coming up this half hour, we're going to talk to Barry Ritholtz all about market moves in 2020, what 2021 looks like it might bring, and lots more coming your way. So let's get a Bloomberg Business Flash first now from Greg Jarrett.
Bonnie, we're sponsored by the New Jersey Institute of Technology, transforming computing professionals into data scientists to meet the demand in this fast-growing field. More at njit.edu/Jersey City. The S&P is gaining for a second day, even after House Republicans blocked Democrats' attempts to meet President Donald Trump's demand to pay most Americans $2,000 to help weather the pandemic. Stock 600 index edged higher after UK and European Union negotiators finalized the trade agreement. Let's take a look at where the numbers stand now. The S&P is up 0.1% up 3. The Dow is little changed, up 14. The NASDAQ is little changed, up 7. The 10-year is up 3/32 with a yield of 0.93%. West Texas Intermediate crude oil is down 0.3% at $47.98 a barrel, with COMEX gold up 0.25% at $18.8270 an ounce. The dollar yen 103.64, the euro $1.2187, and the British pound $1.3553. John Riding, Brain Capital Chief Economic Advisor, tells Bloomberg mass vaccinations will help the economy, but much of the damage, he fears, has already been done.
Those parts of the economy, in leisure and hospitality, where we've got some 4 million job losses since February, when that business can come back, we can start to think of a more normal economy. The question is, how many of those businesses will remain?
That is a Bloomberg Business Flash. I'm Greg Jarrett.
This is Bloomberg Markets with Paul Sweeney and Bonnie Quinn on Bloomberg Radio.
All right, it is year end. It is a good time for investors to step back, take a look at their portfolios, take a look at what they like, what they don't like, maybe some changes for 2021. Let's do that right now with Barry Ritholtz. Barry is a Bloomberg opinion columnist and host of Masters in Business on Bloomberg Radio. He's also the founder, chairman, and Chief Investment Officer of Ritholtz Wealth Management. Barry, thanks so much for joining us here. I'm sure you are communicating with your clients at this time of the year. And as we put this year of all years into context, what's kind of the message you're trying to get across to your clients right now as we think about next year?
Sure. Happy holiday, guys, and thanks for having me. It's funny. We start the process at the end of the third quarter, beginning of the fourth quarter, discussing the sort of moves you need to be thinking about making before the year ends. And in a normal year, in a typical year, the advice is usually pretty straightforward. Max out your retirement accounts, any tax-advantaged accounts, do whatever contributions you're going to make to your HSAs, your 529s, any plan that has a cap on it, you want to try and max it out. But 2020 was not the usual year, and so lots of the advice that we find ourselves giving is a little bit unusual relative to what the typical year looks like.
What kind of advice, though, will you be looking to give next year, do you think, Barry? I mean, from what we can deduce of what might be a Biden administration and what that will entail.
So, generally speaking, I think everybody puts way too much emphasis on the calendar flipping like it's some magic reset and we all get to start over. What typically happens is how the year ends is not all that different from how the year begins, and all of the underlying trends tend to continue. That said, the big change from 20 to 21 is going to be the widespread adoption of the coronavirus by most of the population. I suspect that it not only is it going to be distributed fairly rapidly, pretty well distributed within the first half of the year. I think I'm a little bit of an outlier that the return to normalcy, not just society, but the economy, is going to be faster than a lot of people on Wall Street think. There's just so much pent-up demand, and people are just so tired of being stuck at home, living the same Groundhog Day over and over again, that we're very much going to want to get back out of our houses, into our offices and restaurants and bars and clubs and whatever else.
So, Barry, given that's the case, that sounds like you're ready for that reopening trade. That's kind of how you've been positioning here. So are you still happy to own, the Pelotons of the world, or is it time to get out of those and really get into those names that are going to really benefit from what most expect to be, a much stronger second half of the year?
So Peloton is a great example, and it doesn't just have to be Peloton. It could be Peloton or Moderna or Tesla or any of the giant gainers this year. There's some small cap healthcare stocks like NovaArt, and I'm drawing a blank on the other one. They're up 2,000 and 3,000%. Tesla's up 700%. Moderna's up, I think, 600%. And what ends up happening with a lot of people is they look at their portfolio, and suddenly half of their, liquid net worth is one stock. And that creates a real problem for risk management. I mean, if you're okay with your portfolio manager and your volatility behaving like a chimpanzee that just discovered cocaine, you're fine. But I think at this point in the year, and we still don't know what's going to happen with taxes next year, it's not the worst idea to start peeling off some of those massive gainers and rotate it into something. Even the NASDAQ 100 is going to be less volatile than any of those names that are up, triple digits or more percentage-wise, because they're going to see some sort of volatility in the future. And so it might make sense to cut some of that back and just diversify, whether it's the total market index or if you want to stay with tech, the NASDAQ 100 composite. You're spreading some of the risk around, and you're not going to be that hyper-concentrated, which can be really problematic for a lot of people, not just for the volatility, but for how much sleep they get at night.
Briefly, Barry, who is the end-of-year Masters in Business candidate?
So this weekend is Jeff Pogge. He is the CEO of the Macintosh Group. That is probably the highest-end audiophile group of electronics. They make things like Rotel and Sonos Fabers in addition to Macintosh, and just really a fascinating. You would think an entity like that would be having a poor year. It's actually a record-breaking year. Macintosh Group has their best numbers ever. Some of it is the work-from-home trade, and some of it is just people spending a lot of money.
Well, Barry is sticking around for more. That is Barry Ritholtz, Masters in Business host and, of course, the founder of Ritholtz Wealth Management. Let's get down now to Washington, D.C. for all of the world and national news with Nathan Hager.
Vonnie, 4.5 years after the Brexit vote and with a week to spare till the deadline, the UK and the European Union have agreed on their post-exit trade relationship. European Commission President Ursula von der Leyen speaking through an interpreter.
We can finally put Brexit behind us.
In UK, Prime Minister Boris Johnson's calling it the biggest trade deal in his country's history.
We've taken back control of our laws and our destiny. We've taken back control of every jot and tittle of our regulation in a way that is complete and unfettered.
The deal calls for tariff and quota-free trade on goods, but not services. Johnson says he'll put the agreement to a vote in Parliament on Wednesday, one day before Brexit. House Speaker Nancy Pelosi has set a vote for this Monday on $2,000 stimulus checks for most Americans. That's after Republicans shot down a Democratic effort to replace the $600 payments in the pandemic relief bill by unanimous consent. Now, President Trump has threatened not to sign the entire $900 billion stimulus because he thinks those checks are too small. Democratic Congresswoman Debbie Dingell says that would risk a government shutdown.
Was this bill perfect? No. But it was a down payment on getting COVID relief to the people of this country.
The House also votes Monday to override President Trump's veto of the $740 billion defense bill. California is the first state to reach 2 million confirmed coronavirus cases. More than 23,000 Californians have died of COVID-19. That faster spreading strain, first detected in the UK, has now been confirmed in a German patient. A British study finds the variant is 56% more contagious, though there's no evidence it's more or less severe. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nathan Hager. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Stocks have started in the fluctuation mode in holiday shortened trading as investors monitor the latest developments on the congressional aid package, while the pound is stronger after a post-Brexit trade accord agreement has been reached. Let's take a look at the numbers as they stand now. The S&P is, well, it's fluctuating. It's little changed right now, up 2. The Dow is little changed, down 9. And the NASDAQ is little changed, up 7. The 10-year is up 3/30 seconds with a yield of 0.93%. West Texas Intermediate crude oil is down 0.3% at $47.97 a barrel, with COMEX gold up 0.25% at $18.83 even per ounce. The dollar yen, 103.64. The euro, $1.2185. The British pound, $1.35.48. Extensive delays at the U.S. Post Office have pushed millions of Americans to do one thing they swore they wouldn't do this holiday season. That's go inside a store to shop. Today, parking lots seem to be filling up across the U.S., with shoppers grabbing last-minute items after finally admitting to themselves the in-transit orders they placed online days or weeks earlier might not make it in time for tomorrow. That's a Bloomberg Business Flash. I'm Greg Jarrett.
This is Bloomberg Markets with Paul Sweeney and Bonnie Quinn on Bloomberg Radio.
Going to bring back Barry Ritholtz to join us once again. Barry Ritholtz, Bloomberg opinion columnist and host of Masters in Business on Bloomberg Radio. He's the founder, chairman, and chief investment officer of Ritholtz Wealth Management. Barry, I want to talk about ETFs. It's been one of the big growth stories in financial services over the last several years. And, we have Eric Balchunas from Bloomberg Intelligence sharing his knowledge with us often as we talk about that business. Tell me how you view ETFs. To what extent do you use them in your fund? And, give us the thumbs up, thumbs down from your perspective.
Sure. Well, ETFs have this enormous structural advantage over mutual funds. It actually has several. One is that they trade intraday. I think that's the less important one. The bigger one is if you are holding, let's say you want exposure to U.S. or overseas, or pick a niche. U.S. big cap growth like the S&P 500. Well, in the old days, you would buy a mutual fund, and even if you never sold it, there would still be a potential tax liability. One of the holdings in the index gets purchased by another company. There's a capital gain there that gets passed along to the shareholders. You never sold it, and yet somehow you owe taxes. It was sort of a crazy structure, and keep in mind it goes back to the early last century. So ETFs come along, a very different structure, a very different both legal and fictional structure, so that there is no capital gains pass-through. You do not incur taxes until you actually sell your ETF. And so when you want to hold a broad-based index or any other group of equities, you don't have to worry about these sort of phantom tax charges coming along. So they work great for any non-qualified plan. They're very efficient. They're very inexpensive. I think I haven't looked at the most recent update, but when we did it last quarter, about 22% of what we were running, just under $2 billion in assets, are in ETFs, and they just work great.
Interesting. So is it ETFs, are they primarily a retail product for the individual investor, Barry, or has there been institutional uptake?
So it depends on how you're defining retail. Like, I think of retail as mom and pop, either buying and selling the occasional stock or putting money into their IRA or their own long-term portfolio. That's my basic way of thinking of retail. What we do, we're a registered investment advisory firm. We're making investments on behalf of retail investors, and typically it's a 401k or some other tax-qualified plan, or their portfolio, their long-term investing. And so I think it works pretty well in both if you're a do-it-yourselfer or if you're hiring a professional to assist you in both your financial planning and your portfolio management. They slot in really well. But by the way, mutual funds aren't dead. There's still a place for mutual funds. Typically, we see them in retirement accounts, 401ks. It makes a lot of sense there. You get the economies of scale, especially if you're looking at some of the giants like Fidelity or Vanguard or whoever your favorite fund family is. So it's not like ETFs have completely demolished mutual funds. They've just highlighted some of the structural weaknesses of what really is a legal organization structure that, it's almost a century old.
So, Barry, you mentioned taxes as interesting and attractive aspect of ETFs. With the Biden administration coming in, there is a concern, and I guess we'll have to wait a little bit to see what happens in Georgia, that taxes are going to be going up. How are you thinking about the tax environment over the next several years as a money manager?
So it's really an interesting question, and it's so contingent upon so many different things. The three big areas that people tend to ask questions about: your personal income tax, your capital gains tax if you're buying or selling any asset, whether it's a stock or a house, and then the estate tax. For the vast majority of Americans, the estate tax is not relevant. The exemption is $11 million per person, $22 million plus for a married couple. 99% of families are not going to owe any estate tax with that level of exemption. The changes that are being asked about is the personal tax, income tax, and to some degree your business tax, whether it's a C or an S corp or an LLC, a limited liability company, typically a partnership. We saw major changes in the tax rules in the 2017 tax changes. I suspect if we do see the Senate going to the Democrats, which is probably a long shot, I would say 40-60, although who knows, given what the president's been doing, what the impact of any of this is going to be on the voters in Georgia. And these things are always driven by turnout. The expectation is that you're going to see some increases in taxes. You'll see an increase in the corporate tax. Remember, it used to be 30%. It was taken down to something like 18%. It'll probably go back up to somewhere between 22 and 25% with some minimum so that you can't, even if you're profitable, you can't avoid taxes totally. And then if we are to believe the Biden administration, people making over $400,000 per year, which is probably a substantial percentage of Bloomberg listeners, are going to see the Trump tax cuts unwound. It's 1% or 2%. It's not. It doesn't sound like a lot, but if you make seven figures, it's potentially significant money. And then some of the payment for something like Medicaid for all or some expansion of healthcare coverage is possibly going to come from the capital gains side. That's how it was built into the original Obamacare. So I wouldn't be surprised to see that happen. Also, all of this stuff is around the margins. None of this stuff is really very, very significant unless, what we've heard about during the campaign, unless we get something very different. What we're really talking about are little trims around the edge. It adds up over time,
right?
But it's not a giant reconfiguration of the tax code.
Hey, Barry, thanks so much for joining us. We appreciate the extra time there. Barry Ritholtz, Bloomberg opinion columnist and host of Masters in Business on Bloomberg Radio. I highly recommend that podcast. He's also obviously the founder, chairman, and chief investment officer of Ritholtz Wealth Management. I will be sticking with you all for the next 2 hours, expanded Bloomberg Markets. I will be joined by Lisa Abramowitz. She will join us at the top of the hour. We will drive the conversation forward to have more on this shortened trading day. This is Bloomberg.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney.
The Fed action, essentially unlimited quantitative easing.
People have had the rug pulled out from under them overnight.
This could be a lower for longer hit.
The economic news seems to be getting worse and worse.
Breaking market news and insight from Bloomberg experts.
It's possible that this is going to be a scarring recession.
The Fed is really showing that they're doing whatever it takes.
A lot of people don't expect that the economy will reopen in full.
This is really hitting industrial America, and it's a major crisis.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
Good Christmas Eve afternoon. Coming up, we are going to get the latest on the vaccines. Where are they? What is the path to distribution? Plus, we're going to chat with Jeannie Zeno, Bloomberg opinion contributor and professor of political science at Iona College. Get her thoughts on the last days of the Trump administration as well as the stimulus bill. But first, let's go to Greg Jarrett, get a Bloomberg Business Flash. Greg, what do you got for us?
Well, stocks are continuing to fluctuate, Paul. It's a holiday-shortened trading day as investors are monitoring all the latest news that's coming in. For example, the congressional stimulus and what's going on with Brexit as a Brexit trade agreement was sealed. Let's take a look at where the numbers are going right now in this quiet day. S&P 500 is up less than 0.1%, up 2. Dow Jones Industrial Average is little change, down 5, and the Nasdaq is up 0.1%, up 10. The 10-year is up 3/32 with a yield of 0.93%. West Texas Intermediate crude's down 0.3% at 47.98 a barrel. COMEX gold's up 0.25% at 18.8270 an ounce. The dollar yen 103.67. The euro $1.2183. The British pound $1.3548. Mortgage rates have slipped again to a record low for the 16th time this year, 2020, as it fades. The average for a 30-year fixed loan fell to 2.66%, down from 2.67% last week, and the lowest in data history. That is a Bloomberg Business Flash. A special edition of Bloomberg Markets continues now with Paul Sweeney and Lisa Abramowitz.
Thank you so much, Greg Jarrett. We've been talking a lot about the vaccine and what the impact will be, not only on our public health, which will be positive, and we all cannot wait to get it. I don't know about you, Paul, but I know that I
absolutely
cannot wait. I am lined up with my arm ready to get pricked. But in addition, there's a question of the financial aspect of this, how good this will be for the pharmaceutical companies. Joining us now, Sel Hardy, equity analyst at CFRA Research. And I would love your sense, Sel, first of all, of where we are in the vaccine development and who you think is going to come out the ultimate winner from the biopharmaceutical space.
Hi, Lisa. Thanks for having me. So we think essentially that the major revenue opportunity for vaccine developers will be in 2021, especially when you think about the recent discovery of the new variant. We think that the COVID-19 vaccine might need to be re-administered, and if it were to be repeated yearly, similar to the flu vaccine every couple of years, then the opportunity could be vast. So far we've seen Pfizer, BioNTech, and Moderna. We think Johnson & Johnson could be next, and they have a very promising product. They want to come with a single dose, and they have easier refrigeration requirements. So we think in the first quarter sometime, maybe by the middle of the first quarter, we can expect to hear positive news from Johnson & Johnson next.
So, Sel, give us an understanding of kind of the profitability of these drugs. I'm still unsure of these vaccines. I'm still unsure what kind of profit margins, if any, these pharmaceutical manufacturers will, kind of incorporate into the pricing here. Can you give us a sense of how you think it's going to play out for a lot of these big pharma companies?
And if you think basically that it's only a one-time vaccine and it's going to be only administered twice this year and it's over, I don't think there's going to be much opportunity. But following the recent discovery of the new variants in the UK and South Africa, we know now that the virus can mutate. So there are now going to be chances that the vaccine might need to be readapted and re-administered maybe every year or maybe every 3 years. So it could be just like the flu vaccine, and in that sense, we could see a large opportunity there. I think for the first agreements, mainly because those are with the governments, various governments worldwide, we don't think there's going to be a large profit opportunity, especially like Johnson & Johnson and AstraZeneca said, those would be non-profit endeavors. But going forward, there are a lot of uncertainties, so we expect it to be a profitable endeavor.
All right, so there's that aspect of it, the actual inoculations, and there's a question of the fact that we're all going to be spraying down our counters with Lysol from here to whenever we finish with existence. So there's a question about who benefits, not only from Lysol, but also from PPE and other types of materials that I unfortunately do not think are going to go away anytime soon.
Indeed, we think, the standards of hygiene changed, and now we have higher standards for hygiene and infection control in place. This is becoming the new normal. So we expect to see increased use of personal protective equipment throughout 2021 and further. So we think PPE distributor companies like McKesson, Owens Minor, AmerisourceBergen, Cardinal Health, those are all those companies that are set to benefit. They're not only going to benefit from PPE distribution, they're also going to be benefiting from COVID-19 vaccine and therapies distribution.
So is there any concern among investors that, yes, the pharmaceutical companies have done a phenomenal job in a short period of time of coming up with a number of vaccines, but perhaps they've taken resources away or focus away from some other product lines that are really driving the profitability? Has there been any concern about that?
We are hearing a lot of concerns about that, of course. So definitely we are seeing a shift in research budgets. For example, that was the case for Eli Lilly this year. But we essentially think that oncology, which was the key growth area before COVID-19, will continue to be a key growth area for a while. R&D in the field of oncology and immunology continues very strongly. And this is related to the fact that the number of cancer patients worldwide has been on the rise in recent decades. We think oncology will continue to be a key area, and the main companies that will benefit from it are Merck, Johnson & Johnson, Eli Lilly, Pfizer, and EMY.
So just zooming out, there's a question of how we can incentivize companies to invest more in developing vaccines that could potentially prevent situations like what we experienced in 2020. And that's been a real challenge considering the lack of profitability of some of these vaccines because of the public need. What do you see as the best way of bridging that gap? And I realize that you cover these companies from the financial side of things, but you have an incredible view into what would be required for it to be more win-win than it currently is.
When I think about Merck, for example, Merck is a vaccine developer, and it has been a very successful vaccine developer for many years. Has been very active in the children's vaccine program. So, and they were able to essentially be profitable from the vaccine endeavors. So, the vaccine effort is profitable if it's a long-term effort. In this case, because it had to be very squeezed, there has been a lot of governmental subsidies, and we've seen the Operation Warp Speed coming in. So the government essentially taking a large part of the R&D costs. So if it's a short-term project as this one, the government has to step in. Otherwise, I think if it's a long-term project, the companies can manage to make it a profitable project.
So we're about to get the Biden administration taking office in a matter of weeks. What's the feeling among healthcare investors, broadly defined, about what this new administration may mean for the healthcare space? What are some of the takeaways?
It really depends on the Senate elections result in Georgia and who controls the Senate, essentially. We know that Biden aims to lower drug prices. It's essentially lowering drug prices is becoming a bipartisan issue. We know that President Trump was also vocal about it. But we think that with the Biden administration, this might be a more focused topic, and there might be discussions about maybe tying it to an international price index or maybe lowering certain drug prices. But essentially, we think lowering drug prices will be a key issue.
Thank you so much. Sel Hardy, equity analyst at CFRA Research. We really appreciate your time. Happy holidays. Happy New Year. Let's hope that 2021 is one that is fully vaccinated and wonderfully free of COVID, at least by the end. I'm hopeful.
Yeah, Lisa, I like some of the arguments I've been hearing over the last couple of weeks about how the 2020s will it kind of resemble the 1920s, the Roaring 20s, as the world trying to get past the First World War and of course the Spanish flu, and is it going to be something similar here in the 20s?
Yeah. I hope that's right.
Hope so.
I have some questions about the analogy, but I do see the analog there, and I'm hopeful that is what we see going forward. We'll talk about Brexit. We'll talk about the year to come. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The S&P stays little changed, with technology and real estate shares gaining as financial and energy stocks lead declines. A scuffle over pandemic relief is set to run up against a federal funding deadline next week as Democrats side with President Donald Trump and his demand for $2,000 payments to most Americans. Let's take a look at the markets. The S&P 500 is now up 0.1%, up 3. The Dow's little changed, up 6, and the Nasdaq is little changed, up 7. The 10-year is up 3/32 with a yield of 0.93%. West Texas Intermediate crude oil is down 0.1% at 48.06 a barrel. COMEX gold is up 0.25% at 18.83 even per ounce. The dollar yen 103.67, the euro $1.21.83, and the British pound $1.35.45. Now, with a look at what's going on around the world from our Bloomberg newsroom in the nation's capital, Nathan Hager.
Greg Jarrett, thank you. After 4.5 long years of negotiations and with 1 week till the deadline, the UK and the European Union have reached a post-Brexit trade deal. European Commission President Ursula von der Leyen.
It is fair, it is a balanced deal, and it is the right and responsible thing to do for both sides.
UK Prime Minister Boris Johnson.
Although, of course, the arguments with our European friends and partners were sometimes fierce. This is, I believe, a good deal for the whole of Europe.
And Johnson says he will put that deal to a vote in Parliament Wednesday, 1 day before Brexit. The U.S. House votes this Monday to replace $600 checks in the huge coronavirus relief and spending package with $2,000 payments. As Bloomberg's Irv Chapman reports, President Trump's demand for those bigger payments has put the entire bill at risk.
It's just more of the last-minute haggling he's seen time and again. Andrew Ullman, a former economic advisor to President Trump, said in a Bloomberg interview.
We're pretty close to still getting a deal. There's certainly going to be a few more back and forth between the different parties. The president now has some concerns about the size of those stimulus checks, and they're going to have to work that out. But I'm still pretty optimistic that a stimulus bill is going to get enacted into law in the near term.
Ullman said another 24 or 48-hour extension of government spending could be needed when the House takes up the $2,000 provision on Monday, and Senate Republicans consider their stance. In Washington, Irv Chapman, Bloomberg Radio.
California is the first state to record 2 million coronavirus infections, 2,010,157, according to a Johns Hopkins tally. At the same time, vaccinations are moving along. The Centers for Disease Control says the U.S. leads the world with more than 1.1 million Pfizer doses administered. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. In Washington, I'm Nathan Hager. This is Bloomberg.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
2020 was a year of surprises. 2021, everyone is betting, will be the year of the consensus. Everyone believes that the same outlook will remain the right one, and everyone is piling on board. In fact, some people saying this consensus is the strongest consensus they've ever seen in their financial history. Joining us now, Greg Hahn, Chief Investment Officer for Winthrop Capital Management. And Greg, what's interesting to me is the discomfort that an increasing number of people are having with this groupthink, yet not really being able to find any ways to poke holes in it. And I want to get your take on that dynamic currently in existence.
Hi, Lisa. Yeah, so this is a tough. This is going to be a tough year. Remember, we're living through two experiments. One is the use of aggressive monetary policy globally, which is really supporting higher asset valuations. And the second is navigating a pandemic, which has disrupted the economy. So we don't really have really great measures of what's really going on other than what we're getting from corporations. You know, corporate earnings actually were pretty good. We were surprised. But a lot of the earnings, Lisa, were really propped up because of sales into China, believe it or not. So we're parsing through it. The way that we look at it, the first half of the year is going to be more of a challenge, and the second half of the year is going to show remarkable recovery, setting up a real strong 2022.
All right, so Greg, are you part of the camp that is making that rotation or have made that rotation from some of the larger growth stocks, the Apples, the Amazons of the world that have driven this market really since the financial crisis? Are you rotating into maybe some cyclical names, some smaller cap names?
We are. So but we're very careful about this because one of the problems in the market right now is commercial real estate. And so it's being masked again by the stimulus package that's allowed for some forbearance exist, which those were set to expire at the end of the year. Those look like they're going to be extended if this bill is approved. But on the retail side, we think people are going to go back to the shopping mall. This is not the end of the shopping mall. People want to go back, but the pure play in shopping malls like a Simon Property Group, we would prefer that over an office REIT. We do not think the office REIT is a place to play. So we got to be really careful on how we're approaching it. What about cities in general and the office space aspect? What do you see there? So this sort of happened in 2008. We went through this really short period of time during the financial crisis where cities shut down. We saw an exodus from major cities, but it quickly retraced. This one's going to be a little bit longer cycle, and the reason is the software that is there for people to work remotely is stronger. At the end of the day, though, we're believers. People are coming back to the office. We're coming back to downtowns. People want to be in community, want to work together. So it's going to take a little bit longer, but we'll see a shift in 18 months. But part of what's happening is companies are rationalizing what they're paying for lease and rent expense. This is an opportunity for them to pull back.
So, Greg, are you positioning your portfolio that a lot of the things we're experiencing now in terms of how consumers work and learn and things like that, they're going to be a little bit more permanent than maybe initially thought?
So, yes and no. Again, it's a yes and no answer, Paul. I apologize if it sounds wishy-washy. We are not in the small cap tech space where we're playing companies like Zoom that are monofocused, but we are looking at broader solutions. So we are in Salesforce. Their acquisition of Slack is interesting. Microsoft's a huge leader for us, so that's a core holding for our portfolios. It's a great company and it's resilient. Their business model is just absolutely resilient, and that's really what we're looking for, is that kind of resiliency. Believe it or not, Walmart is one of those plays that we think is a real has sustainability because of the diversity of their revenue through this cycle too. So that's actually one of those plays. But the market's changing with adding Tesla and Amazon in the consumer discretionary sector. There's a lot of shifts that are taking place in the marketplace and how we look at the market. So we're just really trying to restructure that and build portfolios for clients that are resilient.
We're speaking with Greg Hahn, President and Chief Investment Officer at Winthrop Capital Management, overseeing about $1.3 billion from Indianapolis. And Greg, I'm curious about how you frame the recent developments with respect to the stimulus bill in Washington, D.C. It seemed like a sure thing. Both Democrats and Republicans signed off on it. And then President Trump comes out and says that perhaps he will veto it. Then there is the question of the defense spending bill. How much would that change your view going forward if President Trump were to veto this bill and we were not able to get some sort of fiscal support in the very near term?
Well, I think what will happen is if that happens, it'll get pushed into January, and I think it'll get resubmitted with a new president. I think there's a need for the fiscal stimulus. There's an agreement. I think a general agreement for fiscal stimulus, and there's a tactic in negotiating, and I think President Trump has proven this in his business, is that the negotiation starts once you come to the table to sign. And I think that's probably a little bit of the brinksmanship that's taking place right now. This is a negotiation to get it over the hurdle. We think it'll get done.
Hey, Greg, thanks so much for joining us. We appreciate it. Greg Hahn, President and Chief Investment Officer of Winthrop Capital. Actually, Greg, we're going to keep you for a couple of minutes, if you don't mind. We just want to go along with the other issue, Greg. As you think about your portfolio in 2021, there's so many things to worry about, from the vaccines, the pandemic, Brexit, even though we've got some resolution today. What's your big risk heading into next year that you're trying to position your portfolio to be insulated from?
So there's two risks that we're concerned about. One's commercial real estate. And then the second is in the municipal market, the deterioration in the fiscal position of certain cities. And just the municipality piece of it, that the business model isn't working for stadiums, convention centers, airports. And so we have not seen the fiscal impact of that yet. The stimulus bill was silent on assistance for that, and that's a big concern for us. And then the commercial mortgage loan piece of it. During the financial crisis, I think delinquencies went up to 8 or 9%, and today they're really down below 2%. It's masking what's really going on with the deterioration in commercial mortgage loans.
Greg, there's a question also about the economic data that's been coming out that's been deteriorating, which is expected.
Yeah.
However, in some cases, it's been deteriorating more quickly than people had anticipated. I'm thinking, for example, of the consumer spending that we saw this week, which actually declined for the first time since April. And people don't seem to care. They seem to think the near term doesn't matter as long as we get a rebound eventually when we get a vaccine. At what point does the near term data affect your longer term outlook?
So the key for us is the employment picture, and what we have to do is we got to get people back to work, and the people that are unemployed right now are in the service sector. So that's the restaurants, hospitality, gaming, leisure, travel, and that's where once the vaccine takes hold, once we start to see people coming back, that'll provide stability for that consumption. The dip in retail sales was November. Leading up to it, I think leading up to November through October was pretty strong. So we were a little surprised by the deterioration. I think the shopping season, fourth quarter here, is going to probably disappoint, but people want to get back into the stores. The people we're talking to, the work that we're doing, they want to get back in normality in terms of shopping and going to restaurants.
So, Greg, as we think about 2021 here, what are some of the sectors that you guys are looking at here as we kind of think about trying to reposition perhaps somewhat for 2021?
So we've been underweight financials, so we are moving to an overweight in financials. We'll still keep tech probably where it's at, which is a slight overweight, and then we'll add in the consumer discretionary space. But we are trying to manage the risk that Tesla brings to the table. We're not comfortable with that in the consumer discretionary space right now. So, but we're seeing opportunity. We believe it or not, even with these elevated valuations, we see opportunity out there.
Greg, before we let you go, how are you spending the holiday, given the fact that we're all in the weird Alice in Wonderland, world of 2020?
So here's one of the weird blessings, Lisa, in this is my adult children have been home, so we get to spend a longer period of time with our kids as adults than we normally would in any other time period. So that has just been a wonderful experience. So it'll just be a close family, but thank you for asking.
So, Greg, I mean, as you look back on 2020 here, how did your fund perform?
So we actually did. Equity performance has been really strong. Our fixed income performance came back in the fourth quarter, but it had more volatility because of some airline exposure. We had some double ETC exposure that got hit, and I think our focused growth strategy, in spite of the Alibaba news, is going to end the year pretty good. So I'm pretty happy with where we're at. But the problem now, Paul, is what do we do next year? And that's the challenge. Is expected returns on assets are going to be a little bit lower than what we had, and we've been saying that for 4 years. But we knocked the lights out this year.
Greg Hahn, thank you so much for being with us. Happy holidays. Happy New Year. My God, I can't wait to say goodbye to 2020. I'm sure everybody feels the same. Greg Hahn, President and Chief Investment Officer at Winthrop Capital Management, overseeing $1.3 billion from an Indianapolis Christmas, which we're heading into. Greg, are you, Paul, excuse me, are you doing anything interesting?
No. Staying local, no planes, trains, automobiles, listening to Dr. Fauci, kind of the mindset that, this is the last time we'll have to do that, and we'll look forward to Christmas next year. But, I see footage of some fairly busy airports, fairly busy train stations, and that really does not bode well for the next several weeks in terms of virus metrics. So we'll have to just, what a lot of the experts at least are saying, if we can get past, it should have a peak sometime mid to late January. Hopefully that is the case.
Yeah, well, we're going to cross our fingers. We're going to pop some champagne. We're going to put our feet up, and we're going to turn on the television.
That's
From
right.
New York and parts beyond, this is Bloomberg.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
Coming up, we're going to get the latest on the markets. A half hour left of equity trading in a shortened day. Plus, we're going to speak with Jeannie Zaino, Bloomberg opinion contributor and professor of political science at Iona College, and get her thoughts on President Trump upending the stimulus bill and his spree of pardons. But first, let's go to Greg Jarrett of Bloomberg News for a Bloomberg Business Flash. Greg.
Well, Paul, stocks are mixed in holiday shortened trading as investors monitor the latest developments in the congressional aid package, while the pound is stronger after a post-Brexit trade accord agreement was reached. Why don't we take a look at those numbers now? The S&P is currently up 0.2%, up 7. The Dow is up 0.1%, or just less than 0.1%, up 21. And the Nasdaq's up 0.1%, up 16. The 10-year is up 4/30 seconds. The yield is 0.92%. West Texas Intermediate crude's back in the green by 0.1%, up at 48.18 a barrel. COMEX gold is up 0.25% at 18.8290 an ounce. The dollar yen is up 4/30 seconds. The yield 0.92%. And let's take a look now at Fubo TV. It was started with a sell rating and $8 price target at Lightshed Partners, which wrote that the company may be the most compelling short they've ever identified. The stock has fallen as much as 18% in its biggest intraday drop since July. Now, that's a Bloomberg Business Flash. Bloomberg Markets Special Edition continues now with Paul Sweeney and Lisa Abramowitz.
Greg Jarrett, thank you so much. It's wonderful hearing your voice, as always. There's a question heading into year-end of whether this deal that was passed with bipartisan support by Congress to give $900 billion to help support and plug the gap in people's finances as a result of the pandemic, of whether President Trump will now veto it and what the implications are. Joining us now, Jeannie Zaino, Bloomberg opinion contributor and professor of political science at Iona College. Jeannie, what's the thinking that President Trump has in vetoing this bill, vetoing the defense bill like he did last night? What's he going for?
You know, it's been a wild couple days in Washington, and I think, the answer is we don't quite know. We know that he has expressed reservations about the stimulus package. We know he's expressed reservations, obviously, that led to a veto of the defense bill. There's a lot of speculation as to what his motives are, and I would not question those. But what we do know is that we have a Congress a federal government that could shut down. We have a Congress with a bill that hasn't quite reached the president's desk yet, but he could either sign that or veto it or do nothing. And if he either vetoes it or does nothing, it really not only puts Congress in a strange position, but it puts the American public in a strange position, as we will have 10 days before a pocket veto would go through, which would mean the Congress's session would end, a new Congress would come in, and this entire bill would be blown up. So we wouldn't get the COVID relief that people are seeking. So it's a really sort of tumultuous point that we're at this point, and we really don't know where he's going to go. He's now down in Florida, and we don't know again whether he'll veto, sign, or simply do nothing.
So, Jeannie, what's striking? Well, there's many things that are striking about the last several days as it relates to the stimulus discussions, but the lack of coordination or even communication, it seems, between the White House and the Republicans in Congress. What do you make of that?
Yeah, I mean, that's the strangest part of this, I think, for so many Republicans who said they not only had the cooperation, they had the administration in there as part of the negotiations. Steve Mnuchin, who Mitch McConnell and others praised on the Senate floor for getting this bill done. You had poor David Perdue, who is facing a runoff in January 5th in Georgia, tweeting out that they had done the work that was needed for Georgians and he was going home to fight for his election. All of them assuming and thinking they had the support of the White House. And then at the 11th hour, the president came in with this video. And, just back to what Lisa was asking, some of the speculation is the president is frustrated because Mitch McConnell, John Thune, and other leaders in the Senate have said enough is enough about fighting for this election to be overturned. And it's his frustration that they no longer want to fight the Electoral College that led him to this path to blow that up. And that's purely speculation. But to your point, he certainly put his own Republican Party in a very difficult position as they were led to believe he was supportive. And then at the nth hour, he has come in with this massive bit of criticism.
What does this do for the Georgia election?
makes it very difficult for Republicans. I mean, if anything, this is a gift to Democrats who, as we've seen, Nancy Pelosi tweeting, great, you know, we're going to move forward. We can try to get the $2,000 you want. It puts, you know, the Loeffler and Perdue, who are in these runoffs in Georgia, in a very strange position. Remember, one of the reasons Mitch McConnell pushed Republicans to make this deal in the end was because of Georgia, saying we can't keep the Senate if we don't have a deal that these senators can bring home to their constituents. They thought they had that, and now that's been blown up. It really, we're in sort of uncharted territory. Are Republicans really going to come out now and support Loeffler and Perdue, given that they may not get the relief they were seeking, on top of which they have a president who has gone back and forth on whether they could even trust the electoral system in which they're supposed to be voting. So it really puts Republicans in a very difficult position for this runoff. And of course, if they lose both of these seats, then Mitch McConnell is no longer going to be majority leader, and they will lose Washington because they will lose the Senate.
What are the polls saying about Georgia right now, and can we believe those polls?
Yeah, we've seen one of the fascinating sort of undertold stories about this race is that many of the public pollsters have pulled out of Georgia after the general election, in part because they were criticized for polling in a way that didn't turn out the way the results did, in part because of the timing. And a lot of pollsters don't like to poll over the holidays. So we have very limited polling coming out of Georgia, and the polling we have shows it is too tight to call. Most of these polls that I've seen that are, again, the public polls are within the margin of error, meaning this thing could go either way. And I know people hate to hear this, but this really is a case of turnout. And Democrats seem to be turning out people in record numbers, but Republicans usually have an advantage historically in runoffs in a state like Georgia. So again, this thing could go either way.
A lot of investment managers have been watching the Georgia race and actually saying it could be a game changer for them, because if Democrats do take the majority in Senate, we could see a bigger fiscal support package or fiscal stimulus, even actual true stimulus that we could call it that. Do you think that people are a little ahead of themselves in that, given the moderate tilt of a lot of the Democrats that have gotten in?
Yeah, I do think I think it's the right way to be thinking about it, but I do think they're a little bit ahead of themselves. As you mentioned, not only the moderate tilt of the Democrats who have gotten in, but also the fact that the House, the new Congress, will be more Republican than it was or is now. And also the fact that even if Democrats take the Senate, it is by the narrowest of margins. So I think any idea that we are going to see, if we had a Democratic Senate, that we would see a massive stimulus package, I think is not going to happen. And if you look back at the 2008-2009, what Barack Obama faced, he faced something very similar. He was never able to get the deal that most economists said he should, because he couldn't get the moderate Democrats and enough of the Republicans to go along with him. And this is going to be even a narrower Senate. So I think the idea of a massive bill is something that we won't see, but I do think it's the right way to be thinking about it. Within the margins, if Democrats take the Senate, they obviously do have the upper hand on these things. The other prospect is this for Joe Biden, is that he is then going to be even more pressured by the liberals to deliver more, and it's going to be hard given the numbers are so slim. So there's also the flip side of it, if you will, for Joe Biden if they take the Senate.
Jeannie, 20 seconds. I'd love to get your thoughts on just all the pardons we're seeing from President Trump.
Yeah, not surprising, but I think really devastating to the pardon, the pardon power that the president has. And I think the Blackwater ones, the ones that have to do with what happened in Iraq, particularly devastating for the U.S. military and U.S. justice overseas.
Jeannie, thank you so much for joining us. As always, we appreciate your perspective. Jeannie Zaino, political contributor to Bloomberg News. She's also a professor of political science at Iona College, based in New Rochelle, New York. Just giving us her thoughts here on the stimulus. Seems to be bogged down a little bit here. Obviously, the last days, and it really is a time crunch, a cliff, if you will. Hopefully, progress can be made over the next several days. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Stocks are meandering in the final few minutes of this trading shortened day. Markets remain fixated on the completion of the coronavirus aid package and government funding legislation that Congress passed on Monday after President Donald Trump expressed his unhappiness with it. Let's take a look at what markets are doing right now. The S&P 500 is up 0.2%, up 7. The Dow's up 0.1%, up 31. And the Nasdaq's up 0.1%, up 12. The 10-year is up 5/30 seconds with a yield of 0.92%. West Texas Intermediate crude is little changed right now at 48.12 a barrel. COMEX gold is up 0.25% at 1883.10 per ounce. The dollar yen 103.66. The euro $1.21.88. The British pound $1.35.42. Now a look at news here and abroad from Bloomberg's Washington D.C. bureau and Nathan Hager.
All right, thank you, Greg. The post-Brexit trade deal just announced this morning between the UK and the European Union is looking a bit more like a done deal. Prime Minister Boris Johnson says he'll put it to a vote Wednesday. Opposition Labour Party Keir Starmer says his side will vote for it. Johnson is declaring victory.
We have completed the biggest trade deal yet, worth £660 billion a year, a comprehensive Canada-style free trade deal between the UK and the EU.
And while Labour leader Starmer says his party will vote for the agreement, he doesn't sound like he likes it. He's calling it a thin deal, not what Johnson's government promised, but he says no deal Brexit is not an option. House Republicans in Washington have blocked Democrats' attempt to meet President Trump's demand to pay most Americans $2,000 to weather the pandemic. GOP lawmakers objected to passing the bill by unanimous consent. It would have replaced the $600 payments in the latest pandemic relief with $2,000 checks. Bloomberg Government's Emily Wilkins reports this won't be the end of it.
Lawmakers will be back in D.C. on Monday, and at that point they can try to vote sort of through the normal process where they just are going to need a majority.
Even if it does pass in the House, though, it's unclear whether it would make it through the Senate. Republican Roy Blunt says $2,000 checks don't have the 60 votes needed to pass that chamber. The House will also vote Monday to override President Trump's veto of the $740 billion defense bill. Because pandemic relief also includes a $1.3 trillion government spending package, lawmakers could also vote on yet another stopgap to avoid a partial government shutdown on Monday night. Also today, California became the first state in the U.S. to surpass 2 million coronavirus infections since the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. In Washington, I'm Nathan Hager. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
2020. What a year. We're all looking forward
Amazing
to 2021. Yeah, exactly.
Best year ever for everyone.
Just unbelievable. And, you know, it's amazing how these financial markets have reacted. We think, Lisa, back to the depths in that March and April and just the panic in the marketplace. But then the Federal Reserve comes to the rescue. Fiscal stimulus comes to the rescue. And we had this major turnaround in the markets. Now, here we are, a couple days left in the year. The question is, what do we do next year? Alan Zafran, founding partner and co-CEO of IEQ Capital, based in Foster City and Los Angeles, California. He joins us now. Alan, thanks so much for joining us. We really appreciate it on Christmas Eve. Again, what a year. I'd love to get your thoughts on 2021. How are you positioning your portfolio?
Lisa and Paul, happy holidays. Thank goodness we're going to get through this year.
Yeah, we will.
Absolutely.
There's still a couple days left, though. Let's not jinx it. Carry on.
All right. Here's the long and short of it. If you talk to almost any analyst, they'll tell you we're going to go up in the U.S. stock market next year. And the reason is you're going to see U.S. economic growth the fastest it's been since the mid-'80s. And that's because when you pump literally nearly 50% worth of GDP in the form of monetary and fiscal stimulus, which is what we have done this year, you're setting yourself for a boom on the back end of that. So, again, with all due respect to the horrific elements of health crises and literally social and economic crises, and we clearly have problems with inequality. As it relates to the stock market, the money's got to go somewhere. And when cash is giving you nothing, and when bonds give you so little, risk appetites perk up. And with that massive amount of money, equities move higher and other risk assets move higher. All things equal, there's plenty of risks and bumps, but the base case is we keep grinding higher, largely because the money's got to go somewhere. That's your story for 2021.
So another way of putting this, perhaps, is that in 2021, it'll sort of be like what we saw in the second half of 2020. Nothing really matters except for the money keeps flowing, so you might as well buy stocks. Is that the same thing?
Yeah, with luck, yes. Let me give you a little bit of nuance. So,
please.
Let me give you an example. I don't know if you know this, but Brexit finally passed.
I heard about that. Nobody cared. The markets didn't move.
Yeah, right. How many years have we obsessed about that darn thing? Frankly, it's a modest positive. It's not actually that big of a deal, but it's a modest positive. But, one thing that is a good and a bad is if the economy really improves and broadens out, you will finally see this rotation, to a degree anyway, where you start to see the smaller companies perform as well as the larger stocks, and you start to see the value industries do as well as the technology and growth-related stocks. And so it may actually be a year where it's a little deceptive. And what I mean by that is our indexes in the U.S. are now dominated by technology companies. It's possible we'll see a year where the average stock is doing better than that index, the index being market cap weighted, so the big technology companies comprise a big part of that index. It could be, oddly enough, a year the index doesn't go up too much, and actually a bunch of individual stocks do modestly better, because as the economy picks up, businesses that are a lower quality and need economic growth are going to get a little bit of a pickup next year. So industrial stocks, financial stocks, selected consumer-oriented stocks might actually do a little better than the Apples and Facebooks and Microsofts of the world. That's sort of the other element of 2021 is maybe we'll get a broadening of stock market recovery, and that will kind of help everybody a little bit.
Do you embrace that rotation trade there, Alan? It's certainly been successful here, over the last several months. I guess a lot of folks are just saying, how much legs does that cyclical trade, that rotation trade, have in 2021? How do you think about that?
Coming from a guy right here in Silicon Valley, I'm going to be a heretic and tell you I think there's an element of truth, so I embrace it, but only to a modest degree. It's like bulls and bears make money and pigs don't. I think you're crazy to just think I'm going to rotate entirely out of the large cap tech names and go into small cap, low value companies. That's not the trade. You still want to be in strong balance sheet businesses that generate consistent growth. And so you can find, again, financials, industrials, consumer staples that meet that description without being a technology company. And I still think you got to be balanced. Between putting all your eggs in one basket is just a reckless strategy, and it also drives a lot of transactional activity and taxes. So, just be prudent about it. You don't have to find the next Tesla. Just keep balance. But yeah, I do embrace the fact the economy is going to strengthen, and I do think the market will broaden out the participation, and I think it'll end up being a good year. Not an amazing year, but a good year. And the risks include the outcome of the Georgia election, in that the market doesn't want to see corporate tax rates higher. So if both seats on January 5th go to a Democrat, it's possible the market won't react well, because there'll be a perception corporate tax rates might ultimately hike as a result. We certainly need to see the distribution of the vaccines working. And then lastly, ironically, even though you want great economic growth, you don't want the economic growth to be so strong as to create an inflation scare. So if you see interest rates spiking up towards 2% on a 10-year Treasury bond too quickly, we'll get some hiccup in the stock market, because this market is built on low interest rates supporting the current higher than average valuations. And once rates get high enough, gets to the point where they compete with taking, stocks. But I don't think we're going to be in a protracted inflationary environment for at least another couple of years for all sorts of reasons, including our aging population. Older individuals tend to spend less, and we still have some elements of benefit of technology and productivity preventing inflation from coming into play. So that's 2021. It's a good environment, not a great environment for stocks, and a broadening economic outlook.
We're speaking with Alan Safran, founding partner and co-CEO of IEQ Capital. You said a lot there. Let's unpack one aspect. You were talking about the Georgia elections and how a Democratic outcome, if the Democrats ended up taking leadership in the Senate, that could be a negative for the market because of higher regulation and taxes. This actually is a bit contrarian because some people think it's a positive for the market due to more fiscal support. Can you sort of talk about the balance between those two risk factors?
Yeah, absolutely. So various analysts, economists have projected that if corporate tax rates, as stated initially by the Biden platform in the campaign, and of course it could all change, if those corporate tax rates rose from 21 to 28%, it would reduce the earnings per share of the S&P 500 by anywhere from 9 to 15%. So in a vacuum, he said, all we're going to do is raise corporate tax rates. I could argue that if PE multiples stay the same, I could argue that your market's going to take a 9 to 15% hit. You could also give me the argument that a Democratic administration, all things equal, might be slightly more regulatory on technology companies, which comprise part of the index, which could even worsen stock market reactions as well. On the other hand, there is absolutely belief that such an administration will meaningfully increase infrastructure spending, which is desperately needed, and other forms of fiscal spending, which will clearly amplify consumer spending and U.S.-directed corporate spending. And again, now talking about analysts and economists, I've seen ranges arguing that that could actually increase earnings per share on a magnitude of anywhere from 7 to 12%. So I would argue it's a modest negative. Ultimately, I think it's got more headline risk than ultimate economic impact, and it shifts where the winners and losers are. It actually amplifies what we just talked about in a broadening economy. All things equal, those perspectives target technology companies which historically have not paid high taxes. It's going to force them to pay higher taxes, and they might be under greater regulation. The businesses that benefit from greater infrastructure spending tend to be more cursory, basic industry, economically sensitive companies. So it's another argument towards the rotation. I'd argue you would get ahead if both seats go to Democrats in Georgia. I think you'll get a knee-jerk reaction down. Pick your number. It'll take a week or two. Maybe the market goes down. Pick a number, 5 to 10%. I think that's a knee-jerk reaction, and it's the proverbial buying opportunity. In the long run, companies will do just fine. Profits will be made, and those that are fortunate enough to have savings in an IRA or in their own personal accounts, I think they will benefit by owning stocks. So you get a knee-jerk reaction down. It's not a permanent erosion of someone's wealth.
Alan, you mentioned you're in Silicon Valley. One of the stories in 2020, maybe starting in 2019, was the increased regulatory oversight from U.S. officials, not just European officials, but regulators, Congress. What's the feeling in the Valley right now about kind of the regulatory environment as it relates to tech? It's historically been a very light touch. Are they concerned it's going to get a little heavier?
Yes, but I would tell you, everyone around here is always paranoid. And so that doesn't change anything. You always hope for the best and plan for the worst. Another story we're not covering much today is take a look at Alibaba's stock. Alibaba's stock today is down 15%, and it's down 30% from its peak. Why? Because the Chinese regulators have said, we don't like Alibaba's its monopolistic policies, and we're going to go after them. And that's exactly what these largest cap tech companies fear. By the way, lots of the smaller companies of entrepreneurs around here, they love that because they want to be able to, have a more competitive or fair marketplace. So there's two sides to that coin. There's absolutely concern that there will be greater elements of regulation, but usually the bark is worse than the bite. So there's a belief that the regulation probably won't get to the point that it's demonstrably punitive to the business models. Again, I'll have modestly negative impacts, and probably the headlines will actually be worse than the actual damage to the business model in the long run. It's going to be hard for you to convince me that companies like Amazon and Microsoft and Google are going to lose permanent competitive advantages given their scale and first mover advantage in their respective businesses they've entered into.
Before we let you go, Alan, what are you doing for the new year and the holidays?
I'm going to be reading a few books, Think Big, Essentialism. I'm going to take a few walks in the redwoods and clear my mind and hope and pray for a much better 2021 for everyone at every socioeconomic level. This has been a really tough year, so I have a lot of gratitude and I'm counting my blessings. That's what I'm doing.
A wonderful message. Thank you. Alan Saffron, I'm doing probably about half of that, maybe a quarter, maybe an eighth. Definitely less ambitious, that's for sure. No reading, definitely not a walk in the redwoods. I'm trying to wrangle kids. Alan Saffron,
walk in Central Park. That's okay.
Sure. Yeah, I'll check out the mud from the snow and the rain. Alan Saffron, founding partner and co-chief executive officer at IEQ Capital, talking about the redwoods and some lofty goals and really, really wonderful market calls. Thank you for everything, Alan. I will say, in all seriousness, Paul, it actually has been beautiful because after it snowed, it was great. It was going out sledding, it was going out and enjoying the city, and now we're facing down with a very wet Christmas Eve and Christmas
it's going to be windy, so it's going to be tough out there for Santa and the sled, but hopefully he'll be okay.
Yeah, I know that you're worried about him.
Yes.
He'll make it through, I promise. From New York, this is Bloomberg.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney.
Will technology lead us out of this crisis?
The worst jobs market, potentially in history.
The Fed seems to have really flexed its muscles.
How quickly can we recover from this?
Breaking market news and insight from Bloomberg experts.
To wring out that buy the dip mentality, that takes time. Are we looking at a more damaging break in the labor market? Does the shape of the yield curve matter?
We're looking at late 2021, early 2022, where it really feels quote-unquote normal.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
Well, there it is. The bell is closed. 1 p.m. close for U.S. equities on this shortened trading day before Christmas Eve. Lisa Abramowitz and Paul Sweeney. Paul, I got to say, a sleepy day in terms of market action, but just trying to eke out some gains, and we'll talk about that coming up. We'll also talk about the IPO market, which has kind of been going bonkers, and that is the technical CFA language for that. Yeah, absolutely. Right now, let's get a check on where markets closed. Charlie Pellett has that for us.
It was an update. I thank you very much. Do want to begin, though, with developing story. This headline from the Bloomberg Professional Service. New York's December COVID-19 cases have reached a new monthly high. COVID cases up to 236,000, surpassing April. Again, worth repeating, New York's December COVID-19 cases reaching a new monthly high. It was an update on Wall Street holiday shortened session with the Dow, the S&P, NASDAQ all advancing. A lot of the gains coming in the final few minutes of trading. Stocks up for a second day in a shortened session as investors monitor the latest developments on the congressional aid package. The pound strengthened after a post-Brexit trade accord agreement was reached. Here's where we stand. S&P up 13,3703, a gain of just about 0.4%. The Dow up 71, higher by 0.2%. NASDAQ up 33, higher by 0.3%. 10-year yield 0.92%. Gold up 0.4%, 18.79 the ounce. And West Texas Intermediate crude up 0.2%, 48.21 a barrel for West Texas Intermediate crude. So an update on Wall Street. What about the outlook for the new year? Alan Zafran is co-CEO of IEQ Capital, and he was our guest moments ago right here on Bloomberg Markets.
If you talk to almost any analyst, they'll tell you we're going to go up in the U.S. stock market next year. And the reason is you're going to see U.S. economic growth the fastest it's been since the mid-'80s. And that's because when you pump literally nearly 50% worth of GDP in the form of monetary and fiscal stimulus, which is what we have done this year, you're setting yourself for a boom on the back end of that.
So again, today, an update with the Dow, the S&P, and NASDAQ all advancing. A prominent declining stock, though. Alibaba Group Holdings U.S. listed shares tumbled the most ever in intraday trading on concern over China's inquiry into alleged monopolistic practices at the e-commerce company. Alibaba's ADRs are lower today by 13.3%. Again, recapping, 10-year 0.92%, S&P up 13, higher by 0.4%. I'm Charlie Pellett. That's a Bloomberg Business Flash.
Charlie Pellett, thank you so much. We appreciate that. Slightly green here on the screen as it relates to equities. We have one more hour of trading in the credit markets. Let's get a sense of what's going on this quiet Christmas Eve. We do that with Vince Signorelli, Bloomberg News global macro strategist. Vince, thanks so much for joining us here. Anything catch your attention today?
It's been a really sleepy day. I mean, there's still a lot of risk out there that we're not sure which way it's going to go. I want to say thank you, Merry Christmas from Boris Johnson and von der Leyen for giving us Brexit.
They say you're welcome.
So I could stop watching that damn news flow.
But can you, though?
What's that? Yeah, no, actually we can't. But I'm gonna take the small win. At least it's going to be off the radar, in a major way for a little while. And you talk about Sterling making gains. There are a lot of long positions who clearly taken profits into the rally due to that Brexit deal, because there really probably isn't a lot of upside for Sterling from here. But that said, Congress, so Republicans in the House pushed back on the $2,000 stimulus check this morning. Pelosi planning to bring that to the floor on Monday as a standalone, so we'll see how that flies. And we still don't know if the president's going to sign the stimulus package, the bipartisan bill, or if he's going to veto it.
Well, hold on a second. Before you keep going, before you keep going, I mean, I love you. I think you're great. Everything you're saying, yeah. Who is trading today? I mean, I don't think anybody is. I was looking at some of the volumes. I mean, everybody's home. There's nowhere to go.
You know, nobody really wants to take very, very big positions into this kind of a weekend. You're mostly just doing customer flows. And you would be really surprised how it's something like 1 hour to the close, the customer comes in and says, totally forgot, I have to hedge 100 million euros. You know? And they do it. They do it invariably every time because they just let it, I don't know why, but they do it. They let it wait till the last minute. So that's all that traders are really doing, is they're just essentially covering customer flows and maybe themselves cutting positions, taking profit or cutting losses because they don't want to carry them into next year.
So, Vince, you know, it's this fiscal stimulus. I have to admit, the last 48 hours have totally confused me. Now I think I have President Trump kind of siding with Speaker Pelosi and vice versa. I don't know where the Republicans are. I don't know. What is the market trying to parse out here as we just, you know, stumble our way to some type of fiscal stimulus or maybe even face a government shutdown? What's the market kind of telling us here?
The markets really have no idea what the president.
Okay, so I'm not alone.
And what he's thinking. No.
Yeah.
No,
Neither does anybody else. But carry on.
I'm talking to traders all morning. You know, it's the holiday wishes and things like that. And you know, they're asking me, "What do you think he's going to do?" I'm like, I have no idea. I mean, is he going out or trying to go out with his legacy as a bang by saying, "I gave everybody $2,000"? The big pushback from folks, both sides of the aisle, is where was he while the negotiations were going on? He came in at the 11th hour where they finally agreed on something, and he just turned the card upside down. So they're all kind of upset at him, to be honest. And I imagine the American people who are hoping to get a stimulus check next week are none too happy either. The key thing, though, is if this gets dragged down and doesn't pass, and it looks like the Republicans are the ones that stall this, he has actually set the Democrats up for a potential win in Georgia. And he could undermine the party and give them the blue wave, which then the stimulus will come in January, and it will come like gangbusters.
Well, that's a theory that some people have. I can't see it in the market. I'm wondering if there's a certain numbness that people get after a while. I mean, I feel like 2020 is a year when the unprecedented became mundane. Everything that happened where we said this is the first time ever or the first time in 100 years, after a while it's like, yeah, well, what isn't the first time in 100 years? I mean, are people just sort of numb to everything right now?
Well, they're just really waiting to see which way this is really going to go. It's hard. I mean, markets are actually, you know, they're obviously you see the stock market going up and it continues to go up, and they're betting, you know, the second half, as your previous guest spoke, that's going to go gangbusters in the second half. But no one really knows what the first half's going to be or how painful it's going to be with the spread. You know, Charlie mentioned record highs in viruses for New York, where Governor Cuomo shut down the state. I don't think he's going to do it completely, but certainly is going to have to take a page or two from Governor Newsom in California. And now you've got two of the biggest states. I mean, California is an economy all their own. If they're really curtailing economic activity, what does that do to the total growth? You're really hard to see stocks go up because earnings are going to drop in the first quarter if the virus spreads as quickly, say, as it is in the UK. So there's a lot of uncertainty, and people are kind of just trying to jockey this, and they just don't really know what to do.
So, you know, Vince, in the equity markets, we've got a reopening trade, which would be maybe I get out of my Peloton, I get into something cyclical that maybe has kind of lagged. When you look at currencies, is there a reopening trade that, you know, you're seeing investors and traders put on for, you know, a stronger back half of 2021?
I think we're seeing it with the selling of the dollar in the last couple of months. But, you know, a word of caution on that one. If we get a blue wave, and if the stimulus, putting things in perspective, and this is what the market thinks, if we get a blue wave, the stimulus will be even bigger than what Pelosi at first suggested at $3.5 trillion. You could have in the neighborhood of $5 trillion. That would put the deficit at $32 trillion, give or take a couple of bucks. What that will do is you'll see a surge in U.S. interest rates, but you won't see the Fed follow because inflation won't follow straight away. So you're going to see this big boost in real yields in the United States, which will probably more towards the back end of maybe the first quarter, make the dollar look very, very attractive. And it's going to upend a lot of short dollar trades going forward. So it's going to be difficult to try to find what is the pro growth trade, if you will. It's probably going to be that metals will probably come down. And one reason with economic growth, the other reason it's inversely correlated to the dollar. So if my theory holds true and the dollar goes up, we'll see metals come off for two reasons.
I'm sitting here just trying to digest everything that you said and why this is correct. So, okay. So everyone's wrong, and that the dollar you think is going to strengthen next year.
Not necessarily first quarter, but I think by certainly in the spring, if this turns around, yeah, I do, because it's going to follow yields. I mean, you could potentially have 1.5% to 2% in a 10-year yield, with inflation, well below 1%. The dollar could very well be the anti-carry trade, so that people would be selling other currencies where real yields are negative, and investing in the dollar where real yields are positive. It's entirely possible.
All right, we'll keep that in mind. That's a good one to look forward to for 2021.
Fascinating.
Yeah, Vince Signorello, thanks so much for joining us. As always, Vince, Merry Christmas Eve to you and your family. That's Vince Signorello, Bloomberg News global macro strategist, giving us a interesting call there as we think about back half of the first quarter into the second quarter of next year as it relates to the dollar. So obviously we'll have to pay attention to that. Looking at the markets, we have a shortened day. Remember that with the bond market has going to close at 2 p.m. Eastern time. The equity markets closed at 1 p.m. Eastern time. S&P up about 0.3%. The Dow up 0.2%. So a very quiet day on this Christmas Eve. We will drive the conversation forward. Have more for you. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A losing week for the U.S. stock market, and up Christmas Eve, the Dow, the S&P, and NASDAQ closing at session highs. Stocks gaining for a second day in a holiday-shortened session as investors monitored the latest developments on the congressional aid package. The pound strengthened after a post-Brexit trade accord agreement was reached. Technology and real estate shares led the S&P 500 index higher. S&P up today by 0.35%, higher by 13 points, ending the session at 3703. The Dow up 70, up 0.2%. NASDAQ up 33, a gain of 0.3%. 10-year up 5/32, 10-year yield 0.92%. Gold up 0.4%, $18.80 the ounce, and West Texas Intermediate crude up 0.2%, $48.22 a barrel. I'm Charlie Pellet. That's a Bloomberg Business Flash.
You're listening to Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
Well, looking back at the equity markets in 2020, started off just extreme volatility, particularly around that March-April timeframe as the pandemic became just really pronounced across the globe. Since then, an outrageous rally in equity markets, setting all-time highs. When that happens, you get a lot of new companies coming on the market. Let's talk about the IPO market. We can do that with Chris Malik, Managing Director of KeyBank Capital Markets based in Cleveland, Ohio. Chris, thanks so much for joining us here. You know, I actually, am pleasantly surprised, I guess to say, as a former banker, how many companies came public in 2020, given all the uncertainty, given all the volatility. Give us a sense of kind of 2020 from the initial public offering perspective.
Yeah, sure thing. Nice to be on with you, Paul and Lisa. Happy holidays, and hopefully they give you some time off today. But to your point,
from your lips to no, I'm kidding. Carry on.
Yeah, it's really been a banner year for both IPOs and then to a degree SPAC IPOs. But if you go back to the March lows to now, it's really been a tale of two cities. With the major indices trading up strongly and volatility coming down into the low 20s, that's really the right recipe for equities deals getting done, and IPOs in particular. So when we look at the numbers year to date, 140 IPOs for about $65 billion in proceeds. You take a look at those numbers over the same period last year, about 100 deals, to raise about $40 billion. So up significantly in terms of number of deals as well as deal value. And as you know, several high-profile deals pricing here in December, and I see that continuing into the new year.
I just want to apologize. That's me and my sirens out the window. I apologize
From the Upper West Side sirens.
But in fairness, Chris, it answers your question. You said you hope that we get some time off. And in fairness, I am home, and we're about to have a segment on champagne. So it's not exactly like we're suffering here. There is a question, though, of whether things have gotten a little over their skis. And you talk about the SPAC boom, this idea that people are just funneling as much cash as they can into blank check companies that haven't necessarily always outperformed historically. Do you feel like there are pockets of froth here?
I do. Sort of looking at the issuance, on the year, I had the team run the numbers, and 243 SPACs pricing to raise a little bit over $80 billion. With the SPAC versus the traditional IPO, those proceeds get escrowed, and you have roughly 18 months, give or take, to put that money to work. So I think an interesting dynamic will be if we go out into the future, the middle of 2021, when the SPACs have to go out and buy businesses, there's just going to be a mountain of SPAC cash chasing a limited number of targets. I think some of the good tier one targets will fit well, with the SPACs and being public companies. It'll be interesting to see if some of the deals get voted down, but it's certainly a dynamic that we've seen front and center this year. And I think this year, with $80 billion being raised through SPACs, that's roughly the total of the prior decade, going back to 2010.
Hey, Chris, let's talk about what I will consider big misses on the part of investment bankers. I used to do this IPO thing for a living, and if I had priced DoorDash or Airbnb and miss where the opening market trade would be, and so much stock would trade at those levels, I'd be out of a job. What happened, do you think, with DoorDash and Airbnb to miss it? I mean, these aren't billion-dollar market cap companies that are, something.com. These are big companies with big private valuations behind them. What happened?
Yeah, it's always an interesting process, and I think if you start with, the comps are trading, call it between 5 and 10 times forward revenue, and you set the midpoint of your range at a conservative multiple, and you're out and you're talking to investors, and you raise that range once, you raise it twice, and you price at the high end of the range. I think for both of those deals, if memory serves, the valuation was sort of 9 to 10 times forward revenue. That's sort of the intrinsic value, if you will, of what the buy side, of what the institutional investors will pay for that. But once it starts trading, and again, it's a limited number of shares because the float is so small, you sort of have that, what I'll call retail irrational exuberance out in the market that can bid these stock prices through the roof. And as a banker, as you know, you like to see an IPO hold the offer price, trade up a little bit. But I think in the case of DoorDash, that was up roughly 80% the first day. And then, I think Airbnb was up well over 100%. So, in some ways, some tulip mania here in 2020 with those deals. And I think also a final point is, when you have tech IPOs that offer growth and are products and services that people know, that's a typical combination for these huge one-day, one-week pops.
So you think, in other words, that the incredible performance of the IPOs can't last in the same way that we've seen this year?
I don't know that it will last long term. I think this phenomenon happens from time to time. I do think the momentum will carry over into January of next year, and I would say the first quarter more broadly. Personally speaking, right now the pipeline is as robust as it's ever been. So I think you'll see some IPOs price here in January when we're all back at work.
Chris Malik, thank you so much for being with us, for your comments. Merry Christmas. Happy New Year. Chris Malik, Managing Director at KeyBank Capital Markets, talking about that ultra-hot IPO market and the ultra-hot response that IPOs have tended to get this year, completely outperforming. Coming up, we'll pop some champagne. Welcome in the new year. Welcome in the end of the day. From New York, this is Bloomberg.
1%, 48.27 a barrel. As for the market backdrop as we head into the new year, Victoria Fernandez is with Crossmark Global Investments, chief market strategist there. She was interviewed this morning on Bloomberg Television and Radio.
If we don't see the economic numbers really come through and support the optimism that's there in the market, then I think we're set up for a pretty big pullback in the equity market.
And extensive delays at the Postal Service pushed millions of Americans to do the one thing they swore they wouldn't do this holiday season, and that is shop inside stores. Today, parking lots filled across the U.S., shoppers grabbing last-minute items after finally admitting to themselves the in-transit orders they placed online days or weeks earlier might not make it in time for Christmas. Again, recapping here, S&P 500 index up 13, higher by 0.4%. And I'm Charlie Pellet. That is a Bloomberg Business Flash. Lisa and Paul, happy holidays. Back to the two of you.
Charlie Pellet, thank you so much.
Happy
We appreciate
holidays,
that. Happy holidays, absolutely. Lisa, you know, as we make our way towards New Year's Eve, I'm going to make a call here. I'm going to say that people are going to drink a little bit more champagne than they typically do. What do you think?
That they typically do in quarantine or just in general?
I think this is going to be a big year for champagne as we get to New Year's Eve. Let's talk champagne. There's nobody better to do that with than champagne. There you go. Blaine Ashley, founder, New York Champagne Week, and the Fizz is Female platform and website, joining us on the phone from New York. Blaine, thanks so much for joining us. I'm looking at a beautiful bottle of champagne right here. My question is, what is champagne? Are people drinking more champagne in a pandemic and a quarantine than typically?
Well, first off, thank you both for having me. I really appreciate it. And yes, the answer is yes. People are drinking a lot more champagne. They're actually spending more money on wine in general. Sales have been up 30% for champagne since mid-June. So usually most of the revenue for the champagne industry comes in October, November, December. We call it OND. But we've been doing those numbers. 70% of our sales come from that time frame. We've been doing those numbers since June.
Okay, virtual tastings. What is that? Is that a real thing? I mean, do people actually do that and feel satisfied with that?
It is such a real thing because, as you know, as I'm the founder of New York Champagne Week, which has been a live event for the last 7 years, we transitioned to the web this year. In 1 week, we did 10 events. We shipped the champagne experiences to 39 states, and we had over 200 people purchase tickets across the country to attend events like the Fried Chicken and Champagne Bash, which we did with Marcus Samuelson of Red Rooster in your backyard, Lisa, in Harlem.
I love that you know where I live. My God.
Well, yeah. And then we also we paired him up with a champagne brand owner that's also based in Harlem, Rita Jamais, for La Caravelle Champagne. I have actually done 43 virtual tastings since May through December, and that's why I love half bottles, because they're keeping the waistline in check, pennies in my pocket,
right.
All of that jazz, and they're much healthier for you all around, right? So that's why I'm loving half bottles of champagne, which that business is way up, like 50%.
So, Blaine, so people are drinking more. We've heard that from different parts of the spirits industry. Are you finding new champagne drinkers? Are you attracting new people to champagne?
I think so. I think that people are really looking for those little affordable luxuries in life. And so through a lot of the events and the tastings we're doing, we're trying to make it very approachable. Like right now, I have my bottle of Charles Heidsieck open with some popcorn. And the newest craze with caviar is it's ditching the bellinis, but putting it on a potato chip. So it's kind of like all about like the approachable and the diversity that champagne has to offer, diversification. But also champagne is the most food-friendly wine out there. It really pairs from everything really that you can find. And then also champagne is lower in alcohol. So it generally falls in the 12% category, whereas a standard still wine will be around 14%.
I got to say, I'm not sure that you want to reduce alcohol in 2020. Actually, I shouldn't even joke about that. But I'm wondering, going forward, this concept of virtual paired with actual, how do you see this evolving in a world that isn't necessarily beset with pandemic woes?
Right. So after Champagne Week, and this is something I never saw coming as a total small business and one woman show, I started having financial firms and banks, companies reach out to me to do virtual tastings for their clients. So I actually did a few champagne and caviar experiences for Google. I've done some fromage and fizz, so like cheese and champagne tastings for banks like JP Morgan. I never saw that coming. We booked about 10 events between December 8th and 18th. For people that are switching up they can't do traditional client entertaining, so they're looking to do this instead. Another great way that we're getting these virtual tastings out there and giving back to the food and beverage industry, which is obviously hurting majorly right now, is doing a lot of chef collaborations. A lot of these chefs are offering items on sites like Goldbelly, which can ship to 50 states, and they're offering their like signature dish and delivering it to people's doorstep the day before so they can prepare it at home and have these great experiences.
Blaine, what are some of the champagnes that you like right now that you're really suggesting people that they take some time and experiment with?
Right. So I selected some today to chat about. We have the Charles Heidsieck Brut Reserve. That is a great champagne to start off your festivities for the holidays. Looks like cheese and charcuterie board, something like that. It is a blend of the three traditional grapes and champagne. So Pinot Noir, Chardonnay, Pinot Meunier. And it's 11 grams of dosage, which is the sugar. And that's another great thing about champagne. It actually has a lower sugar content than people realize. Most brut champagnes fall between 6 and 12 grams per liter. So that is an excellent talking point about champagne and reason you should be drinking it.
Yep.
And then moving on, we have Billecart Simon Blanc de Blanc. Now, Blanc de Blanc is 100% Chardonnay, and Chardonnay is great with fish. So I would pair that with a feast of 7 fishes, Christmas Eve dinner, hands down. Maybe also if you want to up the ante again, we love caviar and champagne. That's a great pairing. And then you have the Sous Bois, I believe, Paul, correct?
I do.
And that is excellent with your classic Christmas dinner, traditional holiday foods like, turkey, mushrooms, stuffing. I love duck, so I love it with duck.
Oh, perfect.
And then I believe that Lisa has a Laurent Perrier Cuvée Rosé, and we love to pair rosé with dessert around here. So that's a great pairing with apple pie, pecan pie, any sort of like fruit tart. Also, if you're not into like sweets, I'm kind of more of a cheese person, so you could do creamy cheeses, citrusy jams, and figs. Something like that would be perfect with that rosé, and it's also a stunning bottle, right?
It's beautiful. I'm actually tasting another one that you sent over currently because it pairs really well with the radio show.
Yeah, so that's I believe. Are you having the Charles Heidsieck or the La Caravelle?
I'm doing the Cuvée Nina.
Yes, so the La Caravelle Cuvée Nina, and that's what I said off the top. That has been my go-to.
Sorry, I guess I had too much of it.
No, that has been my go-to Zoom wine of the season. And because the brand owner lives in New York, it's been really great for collaboration's sake. She's able to kind of hop on to a lot of these events. So everything we're offering on our website right now for virtual anytime booking, we do with Rita, the owner of La Caravelle, because she's there. And who better to speak to her champagne for these Zoom experiences than the founder herself. And what's great is Rita used to own a iconic restaurant in Midtown called La Caravelle. It closed in 2003, but it was like Kennedy's hotspot, Martha Stewart, like tons of Julia Child. Tons of glitterati went there, and she is like best friends to every single chef in New York. So we have access to these chefs because of the founder of La Caravelle, Rita Jamay.
Champagne Blaine, you made my Thursday afternoon absolutely fantastic. You made it a little bit hairy for Paul, who's a little concerned. I haven't drunk that much. I just opened it at the beginning of the segment. Champagne Blaine, thank you so much. That was fantastic, and I look forward to a very, very fun evening. Champagne Blaine Ashley, founder of the New York Champagne Week and the Fizz is Female platform website, joining us on the phone. It is a nice way to end the week, I've got to say, Paul.
Absolutely, and the bottles are beautiful. And I'm not a huge champagne person. I know a lot of folks are,
well,
but
it's
I
time to get started, Paul.
This
Come
is the time to
on.
get started. Champagne Bleen definitely got me fired up to open this bottle probably this evening.
Yeah, Michelle, open up a bottle of anything. Honestly, coming up, we'll talk about the end of the trading day as we head toward Christmas. Merry Christmas, everyone, and happy holidays on a brutal year for otherwise. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pelleton. Update on Wall Street, the Dow, the S&P, NASDAQ, all advancing today. We saw the S&P 500 index higher by just about 13 points, up by 0.4%. A lot of that having to do with the Brexit agreement, but investors still continuing to monitor developments in Washington and also in Florida. We've got the Dow up 70, a gain of 0.2%. NASDAQ up 33, higher by 0.3%. 10-year yield 0.92%. Gold up 0.3%, 18.79 the ounce. And West Texas Intermediate crude today, we saw WTI up 0.4%, 48.30 a barrel. So again, 10-year yield 0.92%. S&P up 13, higher by 0.4. Keeping an eye on Alibaba. Alibaba Group's listed shares, U.S. listed shares, tumbled the most ever on concern over China's inquiry into alleged monopolistic practices at the e-commerce company. The ADRs, ticker BABA, BABA, lower today by 13.3%. Recapping, S&P up 0.4. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
12 minutes left before the end of the shortened trading day here ahead of Christmas. We're thinking about all of the things to come that will be nice and bubbly, just like the champagne that we were just talking about and now drinking. Joining us now to discuss the outlook for perhaps an area that needs to see brighter days if you look in some of the bigger cities, but certainly is seeing brighter days if you look at the likes of Florida, is Bonnie Stone Sellers and Jeff Highland, co-founders of Forbes Global Properties, taking a look at the luxury outlook. Just to give you a sense of what Forbes Global Properties is, it's a luxury portal, membership only for elite real estate firms showing high-end residences across the world. So, Bonnie, if you could just start by giving us a sense of what you do and how much interest you have seen at a time of such bifurcated fortunes.
It's an incredibly interesting time to be launching a consumer marketplace and an elite brokerage network. 2020 was clearly the year of the home, and although there are a few cities that didn't do as well in the luxury real estate world, nearly every place around the world in luxury was reflective of people wanting bigger homes, people wanting second homes, people wanting vacation homes. And accordingly, home sales doubled in the past year. But we see 2021 as being even better for the luxury housing market. There's so much pent-up demand, and foreign buyers will then be going back after the vaccine into lots of markets. And we also see what a great time for a digital platform. If nothing else, the COVID year has taught us that everyone buys things online, looks at things online, and doesn't matter what the price of the home is, it'll start with digital. So we're pretty upbeat about the luxury market and our platform.
Hey, Jeff, give us a sense of kind of the geographic strengths and weaknesses, just, around the world or wherever you're seeing kind of the real demand. Because here in New York City, it seems like everybody's leaving for Florida. What can you tell us?
Well, that's a momentary thing. We all hope everyone comes back to New York. But then you look at areas like the Hamptons and Florida, maybe for taxes, Austin, again, for taxes. Southern California, it's a boom time again. And I hate to say that COVID had something to do with it, but I had a client whose house we have for sale, or 9 digits, who was asked the question, do you know what caused the Roaring 20s? And he said, no, I don't. And the person answered him, it was the Spanish flu. He said, what do you mean? He said, well, all that pent-up demand from 2 years and deaths and no one doing anything just got everybody out. They wanted to party. They wanted to spend money. They wanted to play. So he said he feels the same thing's going to happen in 21, 22, 23, 24. And we could have a whole nother boom time. And unfortunately, the way that we're going with, the rich getting richer and the poor getting poorer, it is affecting the high end of the market. And what Bonnie and I created here with Forbes Global Properties is a luxury portal. It's basically going to be the Zillow of high net worth individuals. And we'll be able to attract, as we've already had, we're like 12 days out now since we launched our website, to really attract and direct the high net worth individual to the site, and then we'll have them contact directly with our individual agents on the portal, and we're terribly excited about it.
The Roaring 20s, I got to say, Paul, this is what you buy into, right? You think it's going to be the Roaring 20s, the 2020s?
I do, and I absolutely do. I think it's the similarities are pretty telling. So, Bonnie, I mean, one of the things driving real estate in general, and certainly the high end, are just these record low interest rates here. What are your buyers of luxury properties? How sensitive are they to interest rates?
Yeah, I don't think that buyers of high-end properties are particularly sensitive to interest rates. Of course, low interest money is available, and that helps on any purchase. But the luxury market is often an all-cash market, and that's more or less a global phenomena. Having said that, I think that the real estate markets overall will definitely benefit from the low interest rates.
There's a question, Jeff, going back to what you were talking about with the Roaring 20s, I find really compelling, which is, I think about the Great Gatsby and the Hamptons and the scene there. Is that what we're going to do a repeat of? Or is it going to take place in Austin, in Florida? Is it going to take place in new places because of tax reasons, because of other reasons?
Well, the whole thing about East Egg, it was one big mansion on the North Shore. What we're talking about now are people with multiple homes around the world, and almost every home that we sell in Beverly Hills, it's $50 million and up, it's not the primary residence. It could be the fourth, the fifth, the sixth home. So it's so well spread out. And one of the things that attracted Bonnie and me to create Forbes Global Properties is that we now have people from all over the world. We're already in 75 markets. And they come from everywhere. There were waves when maybe you had a certain group who would, let's say, Middle Easterners would come to the United States, or then you had Venezuelans going to Florida, et cetera, et cetera. We've had that whole cycle. So now it's a little of everything coming from everywhere, and it no longer has a distinction of, well, this is the year of the Chinese getting their money out of China. It's coming from everywhere, and I think we'll see throughout the United States people from every portion going, whether it's for business or it's for pleasure or it's even tax avoidance. But we're going to see a boom in the high-end luxury market continue.
Hey, Bonnie, Jeff was just talking.
Portal,
Go ahead, Bonnie.
Can I jump in?
Sure.
Yeah, our portal is not just for the ultra high net worth individual. It's a consumer marketplace. Forbes is an incredibly well-respected business brand with 100 years history and 140 million unique visitors every month who, will be chaperoned to our website. And, there'll be lots of people. All of your audience comes from many industries. They all have one thing in common, and that's that they all have homes. So we think there's a very broad spectrum of consumers who would love to come to our marketplace and see the homes.
Hey, Bonnie and Jeff, thank you so much. We really appreciate it. Bonnie Stone Sellers and Jeff Hyland, co-founders of Forbes Global Properties, joining us. Talks about the luxury market here. It's like everything else in this pandemic, it has taken a pause, but there's certainly a bullish call out there for luxury properties going forward, Lisa. And I think, it'll be interesting to see how New York fares, for example.
Yeah, well, it's not as desolate as you might think, Paul. I will tell you that.
Good. It's good to hear. I miss coming in. I look forward to doing it very soon. And so, Lisa, have a great couple of days, weekends, Christmas, and we get into the new year. We'll have more for you on Bloomberg Radio coming up. This is Bloomberg.
Rising up the ranks from trainee to the boardroom is a pipe dream for many. But some dreams come true. One man who knows the journey well is the chief executive of Roche. Severin Schwan started at the bottom in 1993. Today, he's a lot higher up the ladder, but he never left it. 2021 marks his 28th year at Roche, a doctorate in law, but he made his name in pharma. Schwan became the head of the crucial diagnostics division in 2006. He was handpicked to take over the whole company 2 years later. He says he's fascinated with Roche because the company can create significant value for society, saving lives and improving the quality of life for millions of people and their families. Within his first year as boss, he made the company's biggest ever acquisition, buying Genentech for $47 billion. It was a big bet on the future of medicine, making Schwan one of the most influential leaders in the sector. Today, on Leaders with Lacqua, we meet Severin Schwan, the chief executive of Roche.
Dr. Schwan, thank you so much for speaking to us. How have you changed as a leader since that day in 1993 when you joined Roche?
It's a journey, right? You develop over time, and it's a series of experiences which hopefully make you a better leader. I remember very early on when I joined Roche as a trainee in the early 90s, I had then the opportunity at a very young age to take over people leadership responsibility. I became finance director in Belgium at the time, so it was really from 0 to 100 in terms of people responsibility. And what I really discovered, and I think it still influences me today, was the power of working with a team and the importance of having a motivated team. If you have the right people around you, you have so much more impact. When you're at university, this is a bit of an abstract concept, right? And you have your colleagues and you work together. But if you can form a team and if you have a common goal and you're aligned and you enjoy doing what you do, I mean, this can make such a difference. So the awareness of leadership, working with people, providing the right environment for people, that has been a very important element early on. When I then look, you know, I became CEO shortly after the financial crisis in 2008, 2009. And I remember very well, at that time, you know, investors were very risk averse, and it was all about cash flow, cost restructuring, etc. And at the time, we had some great opportunities in research and development, and we were behaving almost anti-cyclically, and we were investing into research and development because we thought it was the right thing for the long term. I mean, looking back today, I'm so glad we did that because, you know, this is all the medicines and diagnostic solutions which are driving our growth today. It was the right decision. But the point from a leadership point of view I wanted to make is that we had, or I as a CEO had the privilege to think in the long term, and that was very much related to the special capital structure we have at Roche. I mean, Roche is still controlled by the founding families, and they truly, truly think in the long term, in generational terms. And I think good leadership is a lot about doing the right thing in the long term and not just optimizing in the short term. And that is also something which really, really has influenced me. You know, I just became CEO. I had to do something which nobody wanted to do, really. I mean, at least from an investor's point of view. And I saw that it was important and it was a good decision. And therefore today, still today, when I think about shall we take this decision or that decision, I always ask myself, what is the right thing in the long term?
Yeah.
But that's what a moral decision. And going back to how you build a team, what's the secret sauce to have a great team around you? Is it people that are different from you? Is it people that challenge you, or is it people that want the same things ethically?
It's a lot of things. I think from a leadership point of view, what I believe is that in a business like ours, where it's a lot about innovation and creativity, right? We have to turn cutting-edge science into new innovative medicines and diagnostic solutions. I think it's very, very important to give people enough space. Creative people need space. They need air to breathe. They need freedom. If you tell creative people what they have to do, then you get exactly what you tell them to do, right? And you don't get something new. So I think good leadership has a lot to do with giving people a lot of freedom so that they can put their dreams into reality. And you have to orchestrate it, and you have to align it, and you have to give it direction, and you need a common sense of purpose. But I think that's something very, very important. And often, we put people into little boxes and tell them exactly what they have to do. I think you get so surprised when you give people enough freedom, and it's positive surprises.
What's the most difficult thing about being a leader?
Letting go. I mean, we all think that we can do the things better than other people, right? And as a result of that, you always try to intervene, and you always try to tell people how they should do it. And I think leadership has a lot to do with having trust in people. And that also means, and that's difficult, that also means that you are consciously willing to let people fail, and that it is acceptable that people fail. If you truly trust people, then you also need the strength to accept failure, and that is something which is not so easy. It's also not so easy for me, and I've learned that over time. That you might have improved something here or there with your input, but on balance, you probably prevented more if you always told people and if you always intervened. So letting people fail, I think is tough, but I think it's important.
Coming up, pharma and the pandemic. What lessons has Severin Schwan learned in 2020?
It's unprecedented times, and actually we as Roche are at the very forefront in the fight of this pandemic.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
industry is suffering somewhat of a reputational crisis. In recent years, it has more often been attacked for drug pricing than praised for its discoveries. But with the speed these companies have reacted to the COVID pandemic, they may well have a chance to redeem themselves in the eyes of the public. In the quest to develop a treatment to end the crisis, researchers have overcome challenges that would typically take years, if not decades, to beat. Still, there are signs that this rehabilitation is conditional. Any displays of vaccine nationalism could prolong the pandemic and feed the public's skepticism. Roche's Severin Schwan has expressed concern about a lack of international coordination on securing tests and drug supplies.
Dr. Schwan, what has the pandemic taught you about yourself in lockdown, on your priorities? How have you so far lived through the pandemic?
I mean, it's unprecedented times, and actually, we as Roche are at the very forefront in the fight of this pandemic, both on the pharma side, developing new medicines, which hopefully help us to cope with this pandemic, and also very much on the diagnostic side. And what is really good to see, if I look back, is that we were able to react very quickly. And it's good to see that even a big organization like ours can respond very fast and can respond in an agile way. And I think we have touched that in a different context, in the context of leadership. But I think, again, this has to do with the special setup of Roche, which is a very decentralized setup and a very decentralized management model, which actually is very much in sync with this leadership approach in general, where we trust in people, where we empower people, where we delegate decision-making as much as possible. And what that allowed us is that before we at the executive committee or myself even realized what we could do, there were hundreds of people out there who were already working on specific solutions with new medicines, with new diagnostic tests, and could respond in a very, very fast way. So I do believe if you have a crisis like this, it's a big advantage if you have a decentralized setup where people have real authority and don't have to kind of escalate every decision 25 times up and 25 times down, but just get to work, get something implemented for their respective function or in their respective countries. And that worked out very well, I have to say.
How do you see the pandemic actually affecting your industry? Is there a danger that too much work, I mean, I guess you could say it's not enough, but a lot of work is being done for COVID-19, and so other parts are actually being left behind?
That is a risk, and we have clearly seen that during the lockdown. So everybody was focusing on COVID-19, and as a result, patients were not going to their doctor anymore. They were not going to the hospital. And the diagnosis got delayed, treatments got delayed, and that, of course, has medical consequences in the long term. Now, it has improved. People are returning to the hospital, are returning to the doctor, but we are actually not yet back at normal levels. We are perhaps at 80–90% of what we would have seen before the COVID crisis, and that is a concern. That is a concern. We have to do everything to get this pandemic under control. And I'm proud of all our people around the world of what contribution we make here. But let's also be very clear. Most people continue to die from other severe diseases. And we also have a responsibility to serve those patients. And